Hello, and welcome to Session 19 of the Basic Tax course. We're going to begin Session 19 with a review of the Session 17 quiz answer key. And the first question we're going to review in the Session 17 quiz is question number 7, where it reads, the recovery for depreciation claimed on a rental property is taxed at a maximum rate of blank. And the correct answer to that question is 25%. Now remember that there are two predominant capital gain rates, the 0% rate and the 15% rate. But there are specific situations when higher rates may apply. One of the higher rates is the 28% rate, and the 28% rate applies to the capital gain on collectibles. And then there is also a 25% rate that applies to recovered depreciation on the sale of real estate. And since we have depreciation that was claimed on a rental property and that property was sold for a profit, the depreciation recapture rate on that is 25%. Now, I did want to point out that 25% does not mean that 100% of the recovered depreciation is taxed at 25%. Rather, 25% is the maximum rate at which depreciation would be taxed. So you have to look, of course, at a person's tax bracket. If a person is only in the 10 or 15% tax bracket, it doesn't mean that if they sell real estate, they're going to get taxed at 25% on the recovery of depreciation. What it means is that the highest rate that would ever apply to recovered depreciation on the sale of real estate is 25%, and therefore we refer to that rate or recovery rate as a 25% rate, and that makes D the correct answer to question number 7. The next question we're looking at is question number 13. On 1/8/02, Jerry purchased 300 shares of ABC stock for $15 per share. Then on 8/10/05, there was a 2-for-1 split, and on 10/10/11, Jerry sold 300 shares of ABC stock for $14 a share. So what is his net gain or loss? Well, when you get a question like this, you need to look at what's happening. He buys 300 shares for $15 per share, and then there's a 2-for-1 split. The 2-for-1 split occurs on a date earlier than the date where he sells 300 shares. So what that means is that his 300 shares actually turned into 600 shares. And so instead of having a cost basis in his shares of $15 for $3 per share, he will have 600 shares with a cost basis of $7.50 per share. So if he sells 300 shares, it means he sold half his shares, and his basis will be for the half of the shares that he sold. And so we essentially take $15 per share divided by 2, and that gives us $7.50 per share. He then sells 300 shares at a cost basis of $2,250. Now we look at the sale event. And on 10/10/11, he sold 300 shares of ABC stock for $14 per share. So we take 300 times 14, and that gives us $4,200 total sale price. We then say $4,200 of sales proceeds minus out the $2,250 cost gives us a long-term capital gain of $1,950, and that makes C the correct answer. And if you're wondering why long-term, well, long-term is because he obviously purchased that stock almost 10 years ago. It's clearly long-term. The next question is question number 14. On 1/1/11, Fred inherited 100 shares of ABC stock from his father, who died on 12/1/10. Fred's father purchased the ABC stock on 1/1/6 for $3,000, and the stock had a fair market value on 10/1/10 of $5,500. Well, 12/1/10, or December 1, 2010, is the date that his father died. And when you are looking at inherited property, the cost basis that a person has or a beneficiary has in property that they inherited is going to be the value of that property as set by the estate. The estate, most estates will never do valuations because they're so small, they simply don't need to file estate returns. And therefore, for most individuals who ever die, the estate that they have or the property that is transferred from their estate to their heirs will have a cost basis to the heirs of the fair market value on the date of death. And for Fred, his cost basis in the stock he inherited from his father will be the fair market value of that stock on the date his dad died. His father died on 12/1/10, So the fair market value on 12-1 of 10 is $5,500. That is Fred's cost basis. When Fred sells the stock, he sells it on January 5, 2011 for $5,000. You can see right here the math is telling you that it dropped in value from the time he inherited to the time he sold. He has a loss. Now, is the loss long-term or short-term? And the answer is that inherited property is always considered to be held long-term, regardless of how long the beneficiary actually held it or regardless of how long the estate was in existence. And therefore, we throw out the concept of hold the property held more than a year and simply say, oh, it's inherited, therefore it's long-term. The loss is $500. That makes A the correct answer, a $500 long-term loss. Number 17, vacant farmland and a commercial office building are considered to be like-kind property. This one throws people all the time. How can vacant land and an office building be like-kind? Well, they are. The IRS says that all real estate inside of the United States is like-kind to any other real estate in the United States, regardless as to whether it's improved or unimproved, whether it's a commercial building or farmland or a residential rental property. Doesn't matter. We simply look, do we have real estate inside of the United States? Real estate for real estate is always like-kind. Now, if the wording of the problem were, hey, we traded vacant land in England for vacant farmland in the United States, is that like-kind? The answer would be no, because real estate outside of the United States is not like-kind to real estate inside the United States, but any real estate for real estate trade where both properties are in the United States is like-kind, which is why 17 is true. Number 18, which of the following is not Section 1231 property? And we give you the option of inventory, rental real estate property, office furniture, or a breeding cow. Now remember, what is 1231 property? 1231 property is assets used in a trade or business that are subject to depreciation or amortization. And yes, you can depreciate a breeding cow. Obviously, a breeding cow is used to produce cows, more cows, and therefore it is an asset that is used for income production. And it is depreciable. Cows are depreciated over 5 years. Office furniture, that's property used in a trade or business for income production, and it is depreciable over 7 years. And then we have rental real estate property. That's clearly depreciable over 27.5 years or 39 years, depending on whether it's residential or commercial. And the only item left is inventory. And inventory is not an asset that is held for income production. It is an asset, well, it's not even considered to be an asset in the same category as these others. Essentially, inventory is goods in trade or property that is held for sale. It is not Section 1231 property, which is why A is the correct answer. Question number 21. Mr. J purchased a new business use car for $12,000. As down payment, he traded in his old car, which had an adjusted basis of $3,000. The seller of the new car allowed Mr. J a trade-in value of $2,000. How should Mr. J recognize this transaction on his tax return? Well, what we've got here is a like-kind exchange. And what's happening on this like-kind exchange? He's trading an old car for a new car. It is like-kind property, old for new. So what is his basis in the new property? Well, his basis in the new property is going to be his basis in the old property plus any boot he brought to the table. So let's look at it. He purchases a new car costing $12,000, and he has an old car with a remaining basis of $3,000. He trades in the old car, but they only give him $2,000 of trade-in value. So his cost is actually $1,000 higher than the trade-in they give on it, which means he's going to have to bring $10,000 to the table in the form of boot to perfect this transaction. Therefore, his cost will be his original $3,000 cost in the old car plus the $10,000 that he needs to bring to the table to acquire the new car, and it makes his cost basis in the new car $13,000, which is, of course, answer number C. Number 24, a non-business or personal bad debt becomes deductible in the year it becomes worthless as a short-term loss on Schedule D. And it's just a fact you need to know. Personal bad debt is considered to be a short-term loss. You just need to know that. And you claim it on Schedule D. Mini problem. John Greystoke is single, and during the year he sold the following investments: Tantor Inc., 400 shares that were purchased back in 2007 at $10 a share. He sold those shares for $15 a share. Also, Cala Inc. He has 200 shares that he purchased back in 2009 for $5 a share. And on 3/18 of 2011, he sold those Cala Inc. shares for $20 a share. He also has Kerchak Inc., 50 shares purchased in 2010 for $10 a share. He sold those in 11 for $8 a share. And there's a couple things we need to look at here. Firstly, we look at the acquisition dates versus the sales date. All three stocks were sold on the same day, March 18, 2011, but the purchase dates vary. We have 2007 purchase date, a 2009 purchase date, and a 2010 purchase date. Well, it's clearly evident that the Tantor Inc. and the Cala Inc. are long-term transactions. The Kerchak, although it was purchased in 2010, it was not purchased a full year ago. It was purchased only a few months ago, and therefore the Kerchak Inc. is sold short-term. Now let's see what else the problem has to say. John's taxable income on his Form 1040, line 43, is $45,600. Assuming the amount on line 16 of his qualified dividend and capital gain tax worksheet is $6,306, and the amount reported on line 18 of the worksheet is $7,531, prepare his Form 8949, his Schedule D, and the qualified dividend and capital gain worksheet, and then answer the following questions. So this is actually not a horribly difficult problem if you understand how to figure the gains and losses and enter them on the forms. And of course, this problem is asking you to do just that, fill out the forms and get the lines correct. So let's look at each transaction and mentally think about what needs to happen. Tantor Inc., 400 shares that cost $10 a share. Well, $10 a share times 400, that's a cost basis of $4,000. He sells for $15 a share. That's going to be 15 times 400, or $6,000. So that first transaction is going to be a $6,000 sales price minus a $4,000 cost, for a $2,000 long-term gain. Then for Cala Inc., we have 200 shares costing $5 a share. That gives us a cost basis for those shares of $1,000. He sells for $20 a share. 20 times 200 is $4,000. So $4,000 minus $1,000 is a $3,000 long-term gain on Cala Inc. And finally, we have Kerchak Inc., 50 shares. Purchased in 2010 for $10 a share. That's a cost basis of $500. We sell for $8 a share. 50 times 8 is $400. So 400 minus 500 results in a $100 loss. The loss is short-term. Now, it's time to fill out some forms. And just mentally, we got to think about what's going on. Were any of the stocks purchased in 11? None of them were purchased in 11, so we know that they are all non-covered securities. That means when we go over to the 8949, which is the first form we need to complete for this assignment, we are going to have a situation where cost basis is not reported to the IRS, but clearly the sales proceeds would have been reported on a 1099-B. So that means for the 8949, we're going to complete a short-term transaction, we're going to complete a long-term transaction, and in both situations, box B is the box that we're going to check. And after we complete the 8949s, then we will move over to Schedule D. And after we've finished with Schedule D, we will use the information contained in this portion of the problem to prepare the capital gain worksheet. So let's take a look at the finished product. And let's begin with John Gray Stokes, 8949, for short-term capital gains and losses. To compute this transaction, we complete Part 1 of Form 8949. Check box B. We enter a description, which is 50 Kerchak Inc. shares. We show the date acquired. We show the date sold, the sales price, and the cost. Those transaction amounts are totaled at the bottom of the page on line 2, and then we move over to the next 8949. And on the second for 8949, we check box B, and of course we're completing part 2 of the form. We list 400 Tantor, 200 Cala, the purchase dates, the sales date, the sales price, the cost or other basis, and then these amounts are totaled down at the bottom on line 4. Line 4 shows total sales proceeds of $10,000, total cost of $5,000. Next, we go over to the Schedule D, and in Part 1 of Schedule D, we enter the amounts shown in the short-term transactions with box B checked for Part 1 of 8949, and we enter the totals from line 2 of that form. $400 of sales price, $500 of cost, and a $100 loss. That loss carries to line 7. Then in Part 2 of Schedule D for the long-term transactions, we show total long-term transactions from Form 8949 with Box B checked. We have sales price amount of $10,000, cost basis of $5, and a gain of $5,000. We total $5,000 on line 15 and move over to page 2 of Schedule D. On page 2, we total line 7 and 15, and the $4,900 total amount is entered on line 16. From this point, it is time to complete this qualified dividend and capital gain worksheet, and we provided you with the number to enter on line 1. In the wording of the problem, we tell you that that amount is $45,600, and we want you to start with that number. $45,600 is entered on line 1. Next, it asks how much is the amount on line 15, and that amount is $4,900. Then on line 7, we subtract $4,900 from $45,600, and we get $40,700. We then go over to line 8 and pull the figure corresponding to Greystoke's filing status of single. That number is $34,500. His income is greater than $34,500. That means all of his long-term gains will be taxed at a maximum rate of 15%. We follow the form down. We enter $4,900 on line 12. We then multiply line 12 by 15%, and that gives us $735. In the wording of the problem, we told you to enter $6,306, so you enter that number down. We then ask you to add line 15 and 16 together. That gives you $7,041. And then, of course, in the wording of the problem, we told you that the amount to enter on line 18 is $7,531. If you were to go to the tax tables and look up the amount of tax that John needs to pay on $45,600 of taxable income, you would get $7,531. The purpose of the worksheet is to see if John qualifies for a lower tax, and the answer is he does, because the rate of tax he's paying on the capital gain is lower than the ordinary rate, and therefore on line 19 we get to take the lower of the tax shown on line 18 or the tax shown on line 17. That means the correct answer for line 19 is $7,041. That concludes the review of the Session 17 quiz answer key. Let's take a look at the Session 18 homework assignment next. And of course, for the homework assignment, we asked you to complete Form 1040, Schedule A, Schedule B, Schedule D, Schedule E, 4797, 6252, the Schedule D tax worksheet, and the unrecaptured Section 1250 gain worksheet, because Lana Lang sold her rental property on an installment sale. Lana originally purchased the property back in 2002 for $102,000. We provided you with her closing costs. We also tell you that she purchased the home for $102,000, and at that time, the land was worth $22,000. The buyer of the home, Lex Luthor, paid her $180,000 and made a down payment of $40,000 at the time of purchase. Over the years, Lana made the following improvements to the property, and of course those increase her cost. But then again, her cost is decreased by any depreciation she has previously claimed. And we can see that her accumulated depreciation on each of those assets is shown here. And so you're going to have to be reducing her cost basis or making an entry on the Form 4797 and again on the 6252 to account for that prior depreciation. Lana incurred the following expenses in relation to the sale of the property, and we can see we've got $12,000 plus $4,000. Those amounts are going to be reported on the 6252 form. We provide you with a W-2 showing Lana made $80,000 of wage income with $12,000 of federal withholding and $9,000 of state withholding. Now this amortization schedule does a little bit more for you than Diana Prince's did, because we're actually showing you accumulated principal and accumulated interest. For this first year, you don't really have to do much addition. The accumulated principal is $817.46. You're going to add that to Lex Luthor's down payment of $40,000, and that's essentially going to be $40,817 of principal payments from Lex Luthor during the year. And of course, the accumulated interest for the year is $5,702. That will be reportable by Lana on line 8 of her 1040, and she will of course need to attach Schedule B and enter the information for this interest income onto the Schedule B. So let's take a look at the finished answer key. And here we have the answer key for the Session 18 homework assignment. Lana has sold a business use asset under the installment method. She's going to continue to claim depreciation on the rental home through the date of the sale, and a Schedule E is attached. The only expense we gave you is her depreciation. Depreciation is not something you turn off because the home is not being rented. Even if there are no other operational expenses of the rental property, the fact that it was a rental property still available to be in service, even though it's held for sale, we're going to continue that depreciation on it. So we have to complete Schedule E only to claim that depreciation expense and a loss from that depreciation expense. We're going to figure Lana's cost basis in her rental property as follows. The purchase price was $102,000. Title charges of $600. Other closing costs of $800. Points paid on purchase of $600. The new deck, the new fence at $5,000 and $4,000 respectively gives her a total cost basis of $113,000. When we're completing the 6252, we need to make the following entries. On line 5, we're going to enter $180,000 as the selling price of the home. On line 8, we will enter $113,000 as the cost basis of the home. And then on line 9, we will enter $28,949 of prior depreciation claimed. We're going to look at prior depreciation from earlier years of $27,538, and then we're going to add in the current year depreciation of $1,411, and that gives us total depreciation claimed on the home through the date of sale of $28,949. And just to point out this $1,411, that is going to be the allowable loss for Lana. You can pretty much predict that that is the entry that we will make for 2011 depreciation on her Schedule E, and then that Schedule E entry will be the only number entered on the Schedule E. It creates a loss, and that loss will flow through to the 1040 and is claimed on line 17 as a negative entry. Regarding Form 4797, Form 4797 is not used to calculate the gain from the sale of the property that is sold under the installment method. When we did the 4797 in the Diana Prince illustration, we actually had to show all of those different sales amounts being entered on there to figure the gain or loss on each part of the sale. But when we're doing an installment method, the entire sale is reported on Form 6252. We figure the cost basis there, the selling expenses there, we recapture depreciation there. The only thing we use the 4797 for is to show the prior depreciation claimed. And because this is real estate where depreciation has been claimed, it's been sold long term, we're going to complete Part 3 in page 2 of Form 4797. We're then going to figure the gain or loss, and in this case we know it's going to be a gain, on the 6252. The final figure for income for the year carries through to the 4797 from the 6252. And then on to the Schedule D and the capital gain worksheet, and finally the 1040 form. So moving on to Lana's finished 1040 form, we can see she's filing single. We've entered her wage income of $80,000. The cumulative interest amount that we showed you in the problem is $5,702. You can see that $5,702 has been entered on line 8A. Line 13 is showing the capital gain that is being taxed for the year or is being included in income for the year. And clearly, to get this number, we have to do the 6252 and the 4797. So I'll show you that in just a second. But when you're all done, $18,129 is the correct entry for line 13. Line 17 is showing that loss of $1,411, and that gives Lana a total income of $102,420. On page 2 of Form 1040, her itemized deductions for income taxes paid to the state is $9,000. She has a $3,700 exemption deduction, and of course we need to move on to some other forms before we talk much more about her 1040. On the Schedule B, we've identified Lex Luthor as the payor of the interest, his Social Security number, his address, the amount of interest that he paid her, and that amount, of course, carried to line 8 on Lana's 1040. On to the Form 6252. We enter the name, Lana Lang, on the 6252 form. Then a description of the property is rental property. We enter the date sold. We enter the date bought. Was this property sold to a related party? The answer is no. On line 5, we enter the sales amount of $180,000. So the wording of the problem tells us that the property was sold for $180,000. That is the amount we enter on line 5. Then there is no mortgage being assumed, so line 6 is blank. We simply carry line 5 to line 7. 180,000 is entered on line 7. Next on line 8, we enter the cost basis of the property, and we already figured that at being 113,000. As you see on page 1 of the answer key, we totaled up all the original acquisition price, the closing costs, the improvements, and that gave us 113,000. And 113,000 is the amount we've entered on line 8. Next, we look at the amount of depreciation allowed or allowable. Let's take a look at the finished depreciation schedule. So the depreciation schedule that we gave you shows accumulated depreciation for each of the assets. You simply take $27,831, $488, and $630. You add those numbers up, and you get $28,949. These other items here, current depreciation of $1,118, $238, and $55. You add those up, and you get the amount of depreciation entered on the Schedule E, which is $1,411. But moving on with the 6252, we have now entered the appropriate amount of prior depreciation claimed on line 9. And now we do a simple subtraction. Line 9 from line 8 leaves us with $84,051. Next we add in commissions and expenses of the sale. And in the wording of the problem, we told you that real estate commissions were $12,000 and closing costs were $4,000. You add those numbers together and you get $16,000, which is now entered on line 11. We take line 11, we add line 10, and enter the total, which is $100,051 on line 13. Next, we subtract line 13 from line 5. The total is $79,949 entered on line 14. There are no other adjustments to be entered on line 15. And essentially, line 16 of $79,949 is then divided by the sales price, or the contract price of $180,000. And that gives us a gross profit percentage of 44.416%. We multiply 44.416 by the total payments received during the year. And again, I told you that the payments received during the year are the down payment that Lex made of $40,000 plus $817 from the amortization schedule, and that leaves us with $40,817 of total payments for the year. We multiply total payments by the gross profit ratio, and that leaves us $18,129 of installment sale income. If you read the line 26 says, enter here and on Schedule D or Form 4797, see the instructions. So where exactly do you put it? Well, it actually goes on Schedule D and it goes on 4797, but it's going to go on the 4797 first. So let's go there. And here is Lana's Form 4797. You can see on line 4 we've entered the gain from the 6252, $18,129, but we also need to complete page 2 of the form. The purpose of page 2 is to show prior depreciation claimed. We show the sales price, the cost basis, prior depreciation of $28,949, the adjusted basis of $100,000, and the total gain is $79,949. Now it's time to complete Schedule D. We enter the total gain on line 11, which is $18,129. The taxable gain under the installment method is $18,129. We carry that number over to page 2, enter it on line 16, and then on line 19 it asks us to enter the amount of unrecaptured Section 1250 gain. Well, Section 1250 gain is the recovery of depreciation on the sale of real estate that is sold at a gain. And we have prior to depreciation of $28,000. And so we know that when we're reporting the gain from the sale of this property, we're going to have to report the depreciation sale of the gain before we move into the capital gain portion. So all $18,129 of installment payment for the year, or gain under the installment method for the year, is going to be a recovery of depreciation. So $18,129 is going to carry to the Schedule D worksheet. And here's the Schedule D worksheet. You can see on line 7, we've entered the gain under the installment method of $18,129. And all of that gain is going to carry to line 25 and be taxed at a maximum rate of 25%. But before we actually tax the gain at 25%, we need to see if Lana is in a 25% or higher bracket. So we start on line 1 by entering her income from Form 1040, her taxable income, and that was $89,720. So looking at her Form 1040, we look at the amount of income on line 43. That's her taxable income, $89,720. Schedule D worksheet, that's the first number we enter. $89,720 on line 1 of the worksheet. Line 7, we enter the amount of gain that she has under the installment method, and we then subtract $18,129 from $89,720. That gives us $71,591. Is her income higher than the base amount for her filing status? Obviously it is. All of her gain is going to be taxed at the maximum applicable capital gain rate, and in her case the maximum applicable capital gain rate is the 25% rate. $18,129 is taxed at a rate of 25%. That gives us $4,532. The next step is to go to the tax tables and look up the tax Lana would have to pay on $89,720 of income. When you do that, you get $18,740. We also look up the amount of tax using the tax tables that Lana needs to pay on $71,591 of income. And when we do that, we get $14,019. We take $14,019, we add $4,532, and that gives us $18,551. We can take the lesser of line 35 or line 36. 35 is the lesser number, so on line 37 we enter $18,551 and carry that to the Form 1040 and enter it on line 44. And there you see $18,551 entered on line 44. Lana has no credits to claim. She simply moves down to line 62, enters her withholding. Her withholding is short, so of course she owes, and she owes $6,551 for the year. And let's take a look at the other forms that were a part of this assignment. Firstly, her Schedule A, you can see her only deduction is $9,000. That was her total itemized deductions. Her Schedule B again. Her Schedule E. And on the Schedule E, we've entered the address of the property. We've entered the only expense for the property is $1,411 of current depreciation. That $1,411 carried to the 1040 and was entered on line 17. And then also in the answer key for this assignment, you will see the unrecaptured Section 1250 gain worksheet. This worksheet is a worksheet that the IRS tells you to fill out, so we included it in the problem. But again, I always return to that aspect which says, okay, how much of the gain is for depreciation? And that's the amount of Section 1250 gain, and that's the amount that you carry to the Schedule D. But of course, on line 19 of Schedule D, you're going to enter the lesser of the amount of depreciation being recovered for the year or the total taxable gain for the year. And the recovery of depreciation, all of the gain is for that. So $18,129 is the amount of Section 1250 gain that carried to Schedule D. The other thing I need to point out is that the amount of prior depreciation claimed is much greater than $18,000. So we know that for the next year or a few years, the amount of payment that Lex pays to Lana each year she's going to be recovering the depreciation before she moves over to be taxed at the regular capital gain rate of 15%. So for 2011 and 2012 and for a few years into the future, she will be recovering that depreciation. Once she has finished recovering all of the depreciation that she's previously claimed, then any future payments above and beyond the recovery of depreciation, those will get taxed at the maximum rate of 15%, assuming that tax rates don't go up, which in our political atmosphere right now, as we're going into the 2012 election season, I can foresee that for 2013 and future years, capital gain rates are probably going to go up for most people, including Lana. So that concludes the review of the Session 18 homework assignment. It is now time to push pause on video playback and complete the Session 18 quiz. When you are finished completing the Session 18 quiz, please resume video playback for the Session 19 lecture. So again, welcome to today's class. We are going to be talking about rental income and passive activity limits. This is one of my more favorite contents. It's not my favorite because everyone knows depreciation is my favorite topic. And also ranking right up there near the top are credits. I love the earned income credit in particular, and I like talking about that. But, you know, I like rental property a lot, too. So it's always good when I like a topic. I think I have more energy when we're on a topic I really like a lot. And today, of course, we're going to be talking about rental property. And rental property is reported on Schedule E. And gosh darn it all, if the IRS didn't change this form quite a bit on us this year, rearrange a few things and add some extra requirements, And even though I taught an update class, this was just a form I didn't do a very good job of covering in the update. It wasn't until tax season started they went, they did that? They did that? Oh my gosh. And I had to figure out how to do a few extra things in my tax software that I hadn't had to do before. So we're going to be covering what it is that's new and wonderful and different about Schedule E. And I'm just going to zoom in a bit here so you can see it bigger. So you can see what's new and different about Schedule E is we have check boxes up at the top, A and B. Did you make any payments in 2011 that would require you to file Form 1099? And if so, did you? Or will you? That's a new content. Also, for the first time, IRS is actually asking for the physical address of the property. Up until this point, just a description was requested. Now they want to know the address of it. They also want you to enter a code. They've got these codes entered here, and you want to enter the code. And then what's this QJV thing that they've added in? And the days of fair rental use versus the days of personal use. That didn't used to be there that way. It used to be worded differently. Then we move on and we have the income section, which has also got some changes to it. It says merchant card and third-party payments for 2011 enter 0. And then it says payments not reported to you on line 3A. Well, that would be everything else because nothing can go on line 3A this year. And line 4 is the total rent you received. Moving on down the form, we can see on line 23 we have some new lines. Line 23A through G are all new for this year. But fortunately, when we got over to page 2 of Schedule E, just back out a bit, it is the same as it always was. No real changes here. But for both Side 1 and Side 2, or Page 1 and Page 2 of Schedule E, we're going to be taking a close look at this form and how you fill it out, and all the rules that go for putting a number on most of the lines, but not all of the lines. For example, I'm not going to sit here and spend 3 hours talking about income from estates and trusts, but I will go over some of the elementary procedures about how to fill out page 2. So let's take Schedule E from the top. Schedule E is used to report income or loss from rental real estate, royalties, partnerships, S corporations, estates, and trusts. Do not use Schedule E, however, to report income from rental of your personal property, real estate activities as significant services are provided, or royalty income that you receive as a self-employed inventor, writer, artist, etc. So what is rental income? Well, rental income is any payment you receive for the use or occupation of property that you own. All of the following forms of payment are considered rental income and must be reported. The most obvious is which you collected money, either in the form of cash, check, or credit card. The other method is that you received advance rent, so they've prepaid rent. Your tenant has prepaid rent for some future point. Prepaid rent is rent, it is income. A payment for canceling a lease, so your tenant wants to get out early and they have to pay you money for you to let them go, that also is rent. Expenses paid by a tenant on your behalf. If the tenant pays an expense for you and it is not a part of your rental agreement that they pay their own expense, then any expense they pay for you is income to you. And finally, property or services that you receive in exchange for rent are rent and have to be reported as such. Here's an example. You forego rent valued at $1,000 per month or for 1 month if your tenant agrees to paint the house that he rents from you. You must include $1,000 as rental income for that month. If the paint job was a repair, you can deduct the cost of the paint job as a rental expense. Example number 2, you agree to trade rent for your tenant's car. You must include the fair market value of the car as rental income in the year you receive it. I've actually had a client tell me this. You know, he kind of rents he rents some not so spectacular houses to some not so spectacular people, and I've had him tell me he took the guy's car to pay the rent. I've seen that. So, example number 3, your tenant pays the water and sewage bill for your rental property and deducts it from your normal rent payment. Under the terms of the rental agreement, you, not your tenant, is responsible for paying the bill. You must include the amount paid by your tenant in your income, but you can deduct the cost of the utility bill as a rental expense. Security deposits. Security deposits are not rental income if you plan to return the deposit to the party renting your property. However, If you later decide to keep the deposit because your tenant does not live up to the terms of your rental agreement, then you must include the deposit in your income that the deposit is forfeited. So that would be a very normal thing. Most landlords are going to make a request, if it's a good market for landlords, to get first month's rent, last month's rent at the time you sign the lease, and they may also ask for a security deposit, which could be as much as a third month's rent, all up front. And that security deposit is supposed to be refunded to you at the end of the lease, assuming at the end of the period you've lived up to the terms of the rental agreement and you leave the property in good condition. Now, if at the end of the agreement you've trashed the place, or not even trashed the place necessarily, but you've left it so that the landlord has to go and do some serious repairs or clean up after you, the landlord at that time would take the cost of those repairs or cleanup from your deposit. And at that time, the deposit would become income to the landlord. Now, if the deposit from the very beginning is always intended to be non-refundable, then a non-refundable deposit is income to the landlord at the time it is received. But a deposit that is intended to be refunded is not really income of the landlord or money belonging to the landlord. It's essentially held in trust for the tenant to be refunded to the tenant if the tenant lives up to the terms of the lease agreement. Rental expenses. You generally deduct rental expenses in the year you pay them. You can deduct expenses you incur to operate and maintain your rental property, and you can also deduct any expenses you incur while your rental property is up for sale. And this is the up for sale issue that seems to really get a lot of people. My clients and tax preparers both seem to frequently think that a rental property is only a rental property when it's actually being rented. But a rental property that is vacant while it is being held for sale is still a rental property, and you would continue to claim all of the ordinary expenses associated with that rental property up until the date it sells, including depreciation and utilities and anything else you might be paying on it. Repairs and maintenance. Amounts that you spend to keep your property in good operating condition or to repair damage to the property are allowable expenses. Improvements are not deductible expenses. An improvement adds to the value of your property or prolongs its life or adapts it to new uses. You must capitalize the cost of improvements you make to your property. You can generally depreciate items you make, you can generally depreciate improvements you make to your rental property, but treat each improvement as a separate piece of property for depreciation purposes. Now, what IRS means by that is at the time that you convert real estate, let's say you've got a rental house, a residential rental property, at the time you convert it to rental use, they do not want you to break it down into its component parts and depreciate each separately. That's not what they mean. What they mean is at the time you convert the property to rental, you've got the house and you've got the land that the house sits on, and they do want you to separate those out. But typically, you would not go through and do an inventory of every appliance in the place and separate those or depreciate those separately. I don't think there would be anything that would prevent you from doing that, but it's not normally done. Now, once the property is a rental, if you have to start replacing appliances or you have to start making repairs to the property, they do want you to identify whether money you spend on the property has been used to maintain it or repair it, or whether the money was used to somehow improve it. And examples of improvements would be a new roof, a new deck, rewiring, replumbing, replacing a refrigerator. Those are types of improvements. And at the time you make an improvement to the property, that improvement will be separately listed on the depreciation schedule. It doesn't add to the cost of the old property or the main property, which is the house. It's a separate line item on the depreciation schedule. So the types of expenses that are not improvements that you can deduct include things like advertising, cleaning and maintenance services, utilities, fire and liability insurance, taxes, interest, commissions for the collection of rent, and the ordinary and necessary travel and transportation expenses. Okay, now the IRS does go out of its way in publication 527, which is where it describes residential rental property, to get into quite a big discussion about points. In the practical world, I don't really ever have an issue with points not qualifying because they are not de minimis. But if you are preparing for a test or you are accounting other issues where it is possible that a point might not be de minimis, it is important to understand the rules for de minimis, since the IRS goes so much out of its way to describe them in the publication. So a point is another word for a loan origination fee or a loan discount fee. It is a form of prepaid interest, and typically you pay points at the time you acquire property with a loan. The points are intended to buy down the interest rate in most cases. And if you don't pay points, you pay more interest. So they're a form of original issue discount as well. IRS says that when you pay points, those points are not deductible when you pay those points associated with the acquisition of a rental property, for example. If you pay points when you purchase your main home, they're deductible as mortgage interest in the year you buy your home, and you deduct them on Schedule A. But if you pay points when you are purchasing a rental property or refinancing a property, those points are not currently deductible. Instead, you have to amortize those points as a form of interest over the life of the loan. IRS says you can do that if the points are de minimis. And IRS says that de minimis is if the points paid are less than 1/4 of 1% of the stated redemption price at maturity, that is the principal amount of the loan, multiplied by the number of full years from the date of original issue to maturity, being the term of the loan. Well, what does that mean? Well, here's an illustration. On January 1, 2011, you took out a loan for $100,000. The loan matures on January 1, 2021, after a 10-year term, and the stated principal amount of the loan, $100,000, is payable on that date. An interest payment of $10,000 is payable to the bank on January 2 of each year, beginning January 2, 2012. This is a very simple illustration. No loan ever works like that, right? When the loan was made, you paid $1,500 in points to the bank, and the points reduced the issue price of the loan from $100,000 down to $98,500, resulting in $1,500 of original issue discount. You determine that the points you paid are de minimis based on the following computation. You look at the redemption price at maturity of the loan, the principal amount of the loan, that is $100,000, multiplied by the term of the loan in years, 10 years, multiplied by 1/4 of 1%. And when you do that, you get the de minimis amount. That is, the points are de minimis if they're less than this number, and the number being $2,500. If you pay $1,500 of points, that is less than de minimis. Therefore, the points are deductible. And you do it in one of 4 ways. That is, you claim the deduction in one of 4 ways. On a constant yield basis over the term of the loan, on a straight line basis over the term of the loan, in proportion to stated interest payments, or in full at the maturity of the loan. Under the straight line method, you can deduct $150 each year for 10 years. Now, most of the time, loans are for 30 years or 15 years. That's the typical length of time we see on residential property, that the loan is either 30 years or it's 15 years, and so you're going to amortize accordingly. Sometimes there's a balloon payment on a loan. The loan might be shorter because of that. But most loans are 15 or 30 years. Now, if you have property that you have rented that is not for profit, not rented for a profit, if you do not rent your property to make a profit, you can deduct rental expenses only to the extent of your rental income. You report your not-for-profit rental income on line 21 of Form 1040. You may claim your expenses up to the amount of your income on line 23 of Schedule A as a miscellaneous expense subject to the 2% limit. I've really, in all of the years I've done taxes, only had one situation where this came up, where it was abundantly clear to me that this is what I was looking at. And it involved a situation where I had a client who, he's a medical doctor who had spent many, many years in Oregon, in the city of Portland. He loved it here. And after he graduated from medical school, he worked in Massachusetts. And the reason he went to Massachusetts is because if you work as a doctor in Massachusetts long enough, the state of Massachusetts will pay off your student loans. So he decided he'd serve in Massachusetts long enough for his enormous student loans to get paid off. But while he was there, he met a woman and fell in love. And she won't leave Massachusetts. He was hoping at one point she would, so he came to Portland, and he shopped for a house in a neighborhood he liked, and he bought a nice house in a nice neighborhood. And she wouldn't come. So he kept hoping that, she would come. And that if she didn't come, in a year he was going to come back anyway. But he didn't want his house sitting vacant. So he actually found a tenant, and he rented it to this tenant. But he had no profit motive in the rent at all. It was mainly he was looking for someone to live in the property. He was renting it for less than its fair market value. He just wanted to know that the house was being cared for. He had no profit motive in there at all personal motive. So he rented it to these people. And in that year when that happened, we reported the rental income on line 21 and the expenses related to that rental on line 23 of the Schedule A. Another year passed, and he didn't come back. And it came to be a day where, not too long after that first year, that we realized, she was never coming. To this day, he's still in Massachusetts, and he bought this house about 10 years ago, I'd say. So the house is still here. It's still being rented, but there was a period of time where we claimed it for 1 or 2 years on Schedule A because there was no profit motive. And then there came a point where, yeah, I'm hanging on to it. It is a good investment. Now I am going to need to start thinking seriously about renting it for a profit, and it moved over to Schedule E. So that was one example I can think of that not rented for profit has come up. But most of the time, when people rent their property, they have a profit motive, wouldn't you think? De minimis is the minimum. It is less than 0.25% of the stated redemption price of the loan at maturity. Property change to rental use. If you convert your home or other property to rental use at any time after the beginning of your tax year, you must prorate your expenses between personal and rental use. Well, that makes sense. You deduct your prorated allowable personal expenses such as mortgage, interest, and property taxes on Schedule A, and you deduct your prorated rental expense on Schedule E. Now, most tax software has features in place to make this happen. The software we use, Drake Software, asks, is any part of this personal use, and if so, what percentage? And if you enter numbers on a particular screen, it will divide them between Schedule A and Schedule E. I don't like that feature too much. I don't like relying on the software to make all of my decisions for me, but a lot of software has a screen like that or a worksheet like that that will divide rental use for you. But in general, I think the smart preparer, the top dog preparer, is going to really pay attention to what those ratios are and be manually entering them on each form to ensure that they are exactly correct and not getting duplicated. It's pretty easy to enter a number on Schedule A, enter that same number on Schedule E, and have the software double up a number for you because you weren't paying attention. So it is important to pay attention to those details so that your software isn't doubling things up. Here is an example. You convert your home to rental use on April 1 of 2011. You claim property taxes and mortgage interest you paid on your home prior to April 1 on Schedule A. You claim rental expenses you paid on your home from April 1 forward on Schedule E. And here we go in an illustration. Home converted to rental use. Jen converted her home to rental use on April 1, 2011. Her total expenses are as follows. Mortgage interest, $10,500. Property taxes, $2,500. Repairs and maintenance after March 31, $500. Jen must prorate these costs as follows. She takes the interest that was $10,500, divides that by the number of months in the year, which is 12, and then multiplies that by the number of months that she lived in the home, which was 3. That means that $2,625 of mortgage interest would be entered on her Schedule A. She then takes the $10,500 interest amount, divides that by 12 multiplied by 9, to get $7,875, and that is the amount of mortgage interest she would enter on her Schedule E. Now clearly, the total combined mortgage interest claimed on A plus the interest claimed on E should never be more than the interest she paid. That would be one thing to look for when you're working in tax software, you never go over. The next item is the property taxes. $2,500 divided by 12 months times the 3 months she lived in the home equals $625 that will carry to the Schedule A, and $2,500 divided by 12 times the 9 months that it was rented equals $1,875, which should be reported on Schedule E. Now about those repairs, all of the repairs took place after the point it became a rental, so they're all deducted on Schedule E, but no repairs paid before it became a rental should go on Schedule E at all. Those would be personal. Also, beginning on April 1st, because the property became a rental, Jen can begin deducting costs she pays for utilities, insurance, transportation, etc. Now that was an example of a home converted to rental property. What happens if you're just renting out part of your property, like a room? You must report rental income you receive even if you are only partially renting your property. If you rent out part of your property, you treat the rental and personal portions of your properties as 2 separate properties. And here's an illustration of renting out a part of your home. You own your own home and you decide to get a roommate. You and your roommate share certain common areas of your home, and other areas are exclusively used by you or exclusively used by your roommate. You must prorate your expenses between personal and rental. Your house is 2,000 square feet with 3 bedrooms and 2 bathrooms. You would divide the use as follows. Exclusive use to you, 500 feet. Exclusive use to your tenant, 300 feet. Joint use by both of you, 1,200 feet. So what does your use equal? Well, the 500 feet that is exclusive to you plus half of the shared area. And that gives you 1,100 square feet out of 2,000. So 1,100 square feet out of 2,000 is 55%. That means 55% of your home is used for personal purposes. The tenant has exclusive use of 300 square feet plus half of the rest of the area for a total use of 900 square feet. 900 square feet is 45% of the entire home, and that means 45% of the home is used for rental. You will treat all allowable joint expenses for your rental as 55% personal and 45% rental. That leads us to the next discussion topic, which is direct versus indirect expenses. And you may have noticed that your tax software has lines. One line or one column will be for direct expenses, and one column will be for indirect expenses. And your job would be to get the expense into the correct column. If you get into the wrong column, the software will do the wrong thing with it. So certain expenses you incur in operating your joint, personal, or rental property will directly relate to the renting of the property. Expenses you pay that are not directly attributable to the rental portion of your property are called indirect expenses. And I've got an illustration here of how these work. Indirect expenses are prorated based on the percentage of tenant use. Direct expenses do not need to be prorated and are deductible in full. So let's take a look here at an allocation of direct and indirect in this illustration. Mike rents out a part of his home. His home is 55% personal use and 45% rental use. During the year, he had the following direct and indirect expenses. Direct expenses mean that they're attributable to the tenant. He wouldn't have had these expenses if he didn't have a tenant, including repairs to the tenant's room, costing $200, a second phone line for the tenant's use, and advertising for the tenant. All of those expenses, $200, $250, and $80, would be allowed in full on Schedule E. Indirect expenses for that same tenant include mortgage interest, which has to be prorated for the tenant at 45%. So if the mortgage interest costs $6,000, $2,700 carries to the Schedule E. For utilities, if the utilities for the whole house cost $800, 45% or $360 would carry to the Schedule E. Property taxes, assuming those cost $1,500, 45% would carry to the Schedule E, so you would enter $675 on Schedule E. Maintenance of the home and yard, let's say that was $1,000, $450 would carry to the Schedule E, and assuming you are claiming depreciation on the home, because we all know that depreciation is mandatory, you would be carrying depreciation based on rental use as well, 45% of this case, $1,000. I did want to point out there is a special provision for personal use of vacation home or dwelling unit. You must generally divide the allowable expenses for rental of your vacation home between rental and personal use. However, if you rent your home for fewer than 15 days during the year, you do not need to include the rent you receive in your income, and you do not need to deduct your rental expenses. And if you're lucky enough to live near a pretty big event, I don't know, maybe a Super Bowl or the Olympic Games, Salt Lake City had the Olympic Games a few years ago, do you think there might be some demand for vacancy? I would especially think if you're lucky enough to be in a town that has the Olympics. So you might find that, hey, I'll just leave town for the Olympic Games or move in with other family for the Olympics and rent out my house and make a mint, because there would be a demand for it at that one point in time. And IRS is literally saying if you rent your property out for 2 weeks or less during the year, you don't have to report the income. It's one of the few places in the tax code where you can get money and not pay tax on it. It has to be 2 weeks or less. If you rent it for 15 days or more during the year, you have to report the income. Okay, let's take a look now at completing Schedule E. We've kind of just been doing an introduction to kind of the theory behind Schedule E. Now we're actually going to take a hard look at the form itself, beginning with these two new lines, A and B. For 2011 and later years, the IRS has added these two particular lines. They are disclosure requirements. The purpose of the disclosure is to help close the tax gap. The reason for the disclosure is part of Obamacare, our new Health Care Act. They were looking at ways to increase revenue from people who are already supposed to be paying into the tax system. The tax gap is literally the distance between who should be paying tax and who is paying tax. And there's many people out there who are paying taxes as they should, and there are many others out there who are not paying what they should be paying. And so taxes get raised or increased on people who are already paying taxes to help compensate for those who are not already paying the taxes they should. We call that the tax gap. This disclosure procedure or disclosure requirement is an effort to close that gap. And by closing the gap, they hope to raise revenue. Okay? So how would this disclosure requirement affect the client, and how would it affect us as tax preparers? Well, when I fill out a form, the first thing is I don't ever assume an answer for my client. If I have a checkbox here that says, did you make any payments in 2011 that would require you to file Form 1099, yes or no? Well, how would my client know whether or not they're required to file a 1099? If I tell them, that's a very good point. So I would need to know what the rules are for 1099ing. When is a person required to issue a 1099? My job is to prepare to tell them that. And once I've told them what would trigger a requirement for a 1099, then I have to look at the form and say, are there any expenses I'm looking at that this client is going to be claiming on their Schedule E that, in my mind, trigger that requirement? So as a tax preparer making a decision, are there any expenses being claimed on this form that would trigger a requirement? Well, there's all kinds of reasons why a person might have the filing requirement, and I will get to that. But right now I'm just looking at the tax preparer making the decision about which box to check, yes or no. And I'm saying that as a tax preparer, it's your job to know what the requirements are. And if you see that the person is required to issue a 1099, you should check box yes, correct? And then the next question is, if yes, did you or will you file all required Forms 1099? Now, I can't read my client's mind. I need to ask them the question. I have just surmised, based on the information provided to you from you to me, that you are required to issue a 1099 to one or more individuals. Will you do that? Are you going to do that as you are required? And my client will go, do I have to? And I will say, yes, you do. Are you going to? What happens if I don't? Then I have to check no. So I can't check yes knowing that their answer is no. See, this is an ethics issue for the preparer. It's a big ethics issue. So in the past, it might have been a conversation. In a year prior to 2011, it could have been a conversation, well, you're supposed to issue a 1099. I see you've made payments here that trigger a 1099 requirement. Now I've told you you need to do a 1099. I'm going to finish filling out your tax return. That was the old rule. The new rule is I have to tell you that you are required to issue a 1099. I have to get a response about whether or not you have done so or will do so. And based on your response, I need to check yes or no. So it would seem self-evident that if I am required to issue a 1099 and I check no, that the IRS might respond to that. Now, I don't know that their computer systems are advanced enough to be triggering audits based on a yes and no response on here. But certainly, if you're audited for another reason, that would be a question the auditor would have. You've checked no to 1099, but I see yes, you are required to issue them. Or you say yes, you issued them, and no, you didn't. That's an ethics issue right up front. Password number 1 is Crater Lake. C-R-A-T-E-R-L-A-K-E. Crater Lake. So let's get moving here. Part 1, page 1 of the tax return. Man, we've been a half hour on one line. Got to get rolling here. Okay, so part 1 is where we report other information about the tax or about the properties, including on line 1 right here, the physical address of the property, and we also need to select a code. These codes are new. We've never had to select them in the past. IRS wants us to identify the type of property being rented. Single-family residence, multifamily residence, vacation or short-term rental, commercial property, land, royalties, self-rental, or any other type of rental income. Describe what it is if you put a code 8. Line 2 got a bigger blow up here of this section. You may not claim rental losses on property you used for personal purposes during the year if your personal use of the property was more than 14 days during the entire year, or more than 10% of the days that it was rented at a fair rental price. Now, in the past, this question was, did you use the property for personal purposes more than 14 days or more than 10% of the days rented? And that was maybe perhaps confusing to large numbers of people. So now the IRS actually wants you to enter the number of days it was a fairly a rental and the number of days you used it. So the number of days it was a rental might be what the question mark is, because the number of, and so might the number of personal use days. So the IRS does have rules to help you establish when a day is a personal rental day or a personal use day and when a day is a rental day. The IRS says that personal use of rental property includes a day of personal use is any day or part of a day that the unit was used by you for personal purposes or any other person for personal purposes if that person owns a part of the unit, or anyone in your family, or anyone who pays less than a fair rental price for the unit, or anyone under an agreement that lets you use some other unit in, say, a trade. Personal use of rental property does not include any day you spent working substantially full-time repairing and maintaining the unit, even if family members used it for recreational purposes on that day, or any days you used the unit as your main home before or after renting it or offering it for rent, if you rented it or tried to rent it for at least 12 consecutive months, or for a period of less than 12 consecutive months at the end of which you sold or exchanged it. So you need to add up, if the house is vacant, it's still a rental day if you weren't in it or you weren't holding it off the market for rent because of personal reasons. So we're really looking, you've got a rental property there, and when would personal use play into most rental properties? Vacation homes are the big ones. You've got a cottage up on the mountainside that you like to use when you go skiing and you take your family up there on the weekends. But it's in a pretty prime location, so you're logged in with this company that will find tenants for you for vacation rental purposes. And those tenants will come in, and there's certain weeks where you hold or reserve it for yourself, or there's certain weeks that it may just not rent out. And so you say, hey, this weekend I'm going to go up and use it. And when you have those vacation type rental situations, you really do need to be tracking all the days of personal use and all the days of rental use. But for most people, a rental house is a rental house, and it's dedicated to that function. So the days of use don't play in most cases. If I look at all of the rental homes I've ever worked on for clients over a period of 20 years, the number of vacation rentals I've ever dealt with is like 2. There are not that many out there. Most rentals are just dedicated to that function. Yes. Okay, so there's a question in the classroom. I have a house that I lived in, and then I converted it to rental use. Do I treat the time I lived in the home before I converted it to rental use as personal use? Not for purposes of this formula right here. So when we're looking at the fair rental days and the days of personal use, do not count as a personal use day any day you lived in the home before you converted it to rental, or any day you lived in the home after you converted it to personal. We're talking about during the time it was owned as a rental property, did you use it for personal reasons? So if you live in your home up until June 1st, and then you move out and it becomes a rental, and it's a rental from June 1st till the end of the year, 100% of the days it was available for rent are rental days. So in that situation, you would enter fair rental days as the number of days between June 1st and December 31st, and the number of personal days would be 0. That would be how that equation would work. So personal use exceeds 14 days or 10% of the days rented. What happens if that happens? If you use the property for personal use for 15 days or more during the year, you may not be able to deduct all of your rental expenses. Regardless of the number of days of personal use, you can still deduct all of the following expenses for the rental property on Schedule E: mortgage interest, real estate taxes, casualty losses, other rental expenses not related to use of the unit, such as advertising expenses and rental agents' fees. However, if you made personal use of the property for more than the allowed number of days, you can only deduct other expenses, including depreciation, up to the amount of remaining income. If your other expenses exceed your income from the rental activity, these expenses cannot be deducted in the current year. You will need to carry them forward over to the next year. So I'm trying to think. I have one client right now who she's got a cabin in the woods near a ski resort. And she makes money on that baby. I tell you, she has a number of personal days in there every year. Her family makes good use of it. But when it rents for good money. And at the end of the year, she has a profit. So we're not even dealing with these limits per se on her. She's actually making money at it. But you could have a situation where
someone buys their vacation rental in Hawaii, for example, and they manage to get out there for their 2 weeks vacation every year, and then it sporadically rents during high season, but is empty a lot during low season. And so you're actually really concerned with the percentage of days rented and the percentage of days occupied. And if you end up in a situation where you have personal use more than 10% of the days it was rented, then you're going to have a situation where the expenses, you're not allowed to claim a loss based on those other expenses that are not normally deductible by a person on Schedule A. Qualified joint venture. That's a head-scratching thing. What is that? Right here, QJV. Really, it's a self-employment issue and has little to do with most rental properties. QJV stands for Qualified Joint Venture. If you and your spouse each materially participated as the only members of a jointly owned and operated rental real estate business, and you file a joint return for the year, you can make an election to be taxed as a qualified joint venture and report your business income on separate Schedule Cs with your federal 1040 instead of filing a partnership return. So that we'll get into what is the definition of a rental real estate professional or a real estate professional later today. Rental of personal property. Do not use Schedule E to report income from renting personal property. If you rent personal property and you are not in the business of renting property, you would enter income from rental of personal property in line 21 of your Form 1040. And you would claim expenses directly related or directly allocable to that rental income from rental of personal property on line 36. Trying to think, an example I like to use for this is horse trailers. I like horses, and before I had a horse trailer, I would eyeball other people who had horse trailers, because if you try and rent a horse trailer, it's really hard to rent a horse trailer. But maybe you need a horse trailer, and you see someone who has a horse trailer, and you say, hey, bud, if I pay you $100, can I rent your horse trailer? And they might say yes. And that would be an example of personal property rental. And they would enter that on line 21 of their tax return. And if they had any expenses allocable to that rental of the horse trailer, it would go here on line 36 as a line item written in on the line. Merchant card and third-party payments. For 2011 and later years, a new line has been added regarding merchant and third-party network payments. If you accept payments through a credit card, for example, you would need to enter on line 3A the amount of payment you received through a credit card. However, because 2011 is a transition year, the line appears, but they don't want you putting any numbers on it, and your software would not have even allowed it this year. All rental income is entered on line 3B. But beginning in 2012, the IRS will want you to begin dividing payments that you receive between third-party network providers and credit card merchants and actual cash payments or check payments you're receiving directly from your client. So on line 3B, you enter your rental income. Rental income includes gross rental income from any of the following. If you received rental income from real estate and you were not in the real estate business holding the property for sale to customers, and you do not provide significant services to the renter, such as maid service. Significant services do not include furnishing of heat, light, cleaning of public areas, trash collection, or similar services. So IRS says you need to identify the income as rental income, but it is not rental income if you are a real estate professional and it's inventory held for sale, or if you offer services like maid service. Then it's not rental income. In fact, it's self-employment income and belongs on Schedule C. All of the following forms of income should be included on line 3B, including income received from renting a room or other space in your home, fair market value of services or property you receive instead of money as rent, also royalties. Real estate professionals. If you are in the real estate business, use line 3B only to report rent received from real estate held for investment or speculation. Do not use Schedule E to report income and expenses from rentals of real estate held for sale to customers in the ordinary course of your real estate sales business. That income belongs on Schedule C or CEZ, not on Schedule E. Rental income from farm production or crop shares. Report farm rental income and expenses on Form 4835. And you use that form if you received rental income based on crops or livestock produced by the tenant, you did not manage or operate the farm to any great extent, and you are an individual. So you could rent out farmland for actual cash. that the tenant farmer pays you, I don't know, $2,000 a month for your land. Or it could be, instead of collecting $2,000 a month for the land, that tenant farmer gives you a percentage of the crop yield or a percentage of the livestock that was raised on that land and then sold. And if you were receiving a percentage of the livestock or the yield of the land, you report that income as rental income on 4835. If you're actually getting cash payments, you would do Schedule E. Line 4 total. You use line 4 to total up line 3A and line 3B, and since there's only one number on line 3B this year, line 4 and line 3B are equal for 2011. Royalty income. If you receive $10 or more in royalties during 2011, the payer should send you a Form 1099 miscellaneous or similar statement showing you the amount of royalties you received. You should enter code 6 to identify the income as royalty property income. Now, if you received royalty income as a self-employed writer, artist, inventor, you report your royalty income and expenses on Schedule C or CEZ. So one of the better examples I have, I seem to have a number of clients who are musicians. They sing songs, they sell their songs, they get money from the songs, or they produce an album and they're getting money from the album. Those are examples of royalty payments. They do not belong on Schedule E. They belong on Schedule C as self-employment. Line 5 through 19, you enter your rental and royalty expenses for each property in the appropriate column of Schedule E on lines 3 through 19. You can deduct all ordinary necessary expenses such as taxes, interest, repairs, insurance, management fees, agent commissions, and depreciation, but do not deduct the value of your own labor or amounts paid for capital investments or improvements. Let's start here with renting part of your home. Clearly, if you claim a rental expense and you're renting out only part of your home, you have to prorate the expense. We showed you how to do that before the break. Also, credit or deduction for access expenditures. You may be able to claim a tax credit for eligible expenditures paid or incurred in 2011 to provide access to your business for individuals with disabilities, including a rental property. If you had that, you may file Form 8826 for the disabled access credit. You could also possibly deduct up to $15,000 of qualified costs paid or incurred in 2011 to remove architectural or transportation barriers to individuals with disabilities and the elderly. Both the credit and the deduction here I cover in my class next Thursday, the final class in this series of 1040 courses on tax credits for business. That's where I discuss those in further detail. Line 6, auto and travel. You can deduct the ordinary and necessary auto and transportation expenses or travel expenses related to your rental activity, including 50% of meals incurred while traveling away from home. You generally can either deduct your actual expenses or take the standard mileage rate. You can use the standard mileage rate for 2011 only if you owned the vehicle and used the standard mileage rate for the first year you placed the vehicle in service, or you leased the vehicle and are using the standard mileage rate for the entire lease period. Actual expenses. If you deduct actual expenses, include the rental activity portion of the following amounts on line 6. Gasoline, oil, repairs, insurance, tires, etc. You should show auto, rental, or lease payments on line 19 and depreciation on line 18 of Schedule E, not on the auto line, line 6. Standard mileage allowance. If you are claiming the standard mileage allowance, you claim 51 cents for each mile driven before July 1 and 55.5 cents a mile for each mile driven after June 30th. You include your standard mileage allowance along with any amounts you paid for parking or tolls on line 6. The parking and tolls are not a part of the standard mileage allowance. They can be claimed in addition to it. But any other maintenance issues of the car are in place of the standard mileage allowance. There is a Form 4562 requirement. If you claim any auto expenses, whether you are claiming actual expenses or the standard mileage rate, you must complete Part 5 of Form 4562, depreciation and amortization, and attach it to your tax return. Now, one of the things I have observed is that when you're filing a Schedule C and the auto information is required on Schedule C, the IRS will reject the Schedule C if the auto information is not included. You either enter the auto information directly on the Schedule C or you enter it on 4562, which is attached to the Schedule C. and the rest of the return. But IRS, I've noticed, does not reject a tax return that has information on line 6 or claims a deduction on line 6. Even though it says that the 4562 must be attached, it will accept it without it. And that is because line 6 will also accept expenses that are not auto. But as a tax preparer, you should know that any time you file a Schedule E and auto expenses are claimed on the Schedule E, 4562 is a required form. You should be filling it out and attaching it. Line 10, legal and professional fees. Include the following expenses on line 10. Fees for tax advice and the preparation of tax forms related to your rental real estate or for royalty properties. The following expenses are not reported on line 10. Legal fees paid or incurred to defend or protect title to property, to recover property, or to develop or improve property. These costs must be capitalized and added to the basis of the property. Line 12, mortgage interest paid to banks, etc. This is an important line. There are two interest lines, line 12 and line 13. On line 12, you enter only interest that was reported on a Form 1098. If you enter an amount on line 12 that is greater than the amount shown on a 1098, your client will get a letter from the IRS, and they will be very unhappy about that. So if your client paid mortgage interest and it was not interest that was reported on a 1098, you should report that interest on line 13. You can deduct the cost of repairs made to keep your property in good working condition. Repairs generally do not add significant value to the property or extend its useful life. Examples of repairs include fixing a broken lock or painting a room. Improvements that increase the value of property or extend its life, such as replacing a roof or renovating a kitchen, must be capitalized and depreciated. Utilities. You can deduct the cost of ordinary and necessary telephone calls related to your rental activities or royalty income. For example, calls you make to your tenant. However, the base rent, including taxes and other charges for telephone service, or for the main telephone line you have into your residence, is not deductible. And moving on, the next line on, we're near the bottom of the lines already, because we started on line 6 through line 19, and we're already on 18. But 18 is a big one. Now, today's class is not a class on depreciation. We spent 6 hours talking about depreciation last week. So for those of you who are in my depreciation class last week, this will be a good refresher. And for those of you who are not so sound on depreciation, after I cover this portion, you may be full of questions. But we have to move on. So I'm going to cover what I can in this short window of time. Line 18 is where you make expense deduction for depreciation or amortization, or depletion actually. You begin depreciating your property on the first day it is available for rent. If you purchase property and you do not make it available for rent until you complete improvements or repairs, the cost of these repairs and improvements is added to the basis of the property. So let's think about what this sentence is saying. My client purchases a house. The purpose of purchasing the house is to convert it to a rental property or to turn it into a rental property. But the house needs some work first. So she buys the house for $200,000. She thinks it's a good deal. She thinks she's going to be able to make some good rental income off of it, but it needs quite a bit of work first. So she goes in and she rips up all the old dirty carpets. She refinishes the hardwood floors that are underneath. It needs a new roof, so she rips off the old roof, puts on a new roof. The plumbing's old and rusty. No tenant's going to want to live in that house with that plumbing, so she redoes all the plumbing. She also has a bunch of rot, so she replaces some windows and rotten wood and so forth. The yard, it doesn't have a yard, so she goes in and she puts some low-maintenance landscaping in. And it takes 3-4 months to do all that work. So from the time she buys it to the time it's ready to rent, a space of, say, 4 months has passed. During that 4 months, she had to pay utility expenses on the house. She had to pay real estate taxes, prorated at least. She's had to make mortgage interest payments. She's had to pay insurances on the home. She's also paid all of these costs of improving it. And what IRS says is that depreciation for that house begins on the date, the first date, that it is available to take a tenant. Doesn't necessarily mean that the tenant moved in, but it's the first date that she's ready for a tenant. So she starts advertising and she says, I can take a tenant on June 1st. I bought this house on February 1st. On June 1st, I'm going to be ready for my first tenant. Whether or not it gets a tenant on June 1st is beside the point. That's the day it's available for rent. That's the placed in service date. And all of the costs associated with purchasing the property, improving the property, and maintaining that property while it was being improved all add to the cost basis. So they are what we call capitalized expenses. The insurances, the mortgage interest, the repairs, everything she put into that property from the time she bought it till the day it was ready for rent is capitalized, and depreciation begins on the day it's available for rent.
Password number 2 is dwarf, D-W-A-R-F, dwarf.
So Form 4562. You must complete and attach Form 4562 if any of the following is true. Number 1, this is the first year the property is available for rent, or an improvement was made to the property during the year, or you are claiming depreciation on listed property regardless of the date it was placed in service, and I should go, or you claimed auto expense. One more down here. I already covered that up top, but it's a one more, number 4 down here. Land and buildings. If you buy buildings and your cost includes the cost of land on which they stand, you must divide the cost between the land and the buildings to figure the basis for the depreciation on the buildings. If you are not certain of the fair market value of the land and the buildings, you can divide the cost between them based on their assessed value for real estate purposes. So I have an example here of how you would go about doing that, because, I mean, when you buy a land, you don't make an offer to the buyer, okay, I'm going to pay you $100,000 for the land and $100,000 for the house. That isn't how it works. You go, I'm going to give you $200,000, and it's a deal. So it's only when the client comes into us as tax preparers that we're left saying, what's the land value? Because we have to subtract that out. And the land value, we may not have a way of doing that, and it may not in any way tie to what actually was paid to the house in terms of real estate assessments and so forth. So here we have an example. You buy a house and land for a total cost of $100,000. The purchase contract does not specify how much of the purchase price is for the house and how much is for the land. The latest real estate tax assessment on the property was based on an assessed value of $80,000, of which $68,000 is for the house and $12,000 is for the land. So you've paid $100,000 for the house. That is really the fair market value of the house between a willing buyer and a willing seller. But for whatever reason, the county is assessing it at only $80,000. And the county is saying that of that $80,000, $12,000 is for the land and $68,000 is for the house. So what in essence is, the county is saying that 85% of the value of the property is for the house or the improvement on it, and 15% is for the land on which it stands. So you would take that ratio of 85% and multiply it by the purchase price of the house, $100,000, to arrive at the basis in the house for depreciation, $85,000. And the other 15%, or $15,000, is going to be for land and is not depreciable. Basis other than cost. There are many times when you cannot use cost as a basis. You cannot use cost as a basis for property that you received in return for services you performed, or in an exchange for other property, or as a gift, or from your spouse or former spouse as the result of a divorce, or as an inheritance. If you receive property in one of these ways, you should go to publication 551 for basis of assets for information on how to figure your basis. And we cover a lot of those questions in our course called Basis of Assets as well. Adjusted basis. Before you can figure allowable depreciation, you must make certain adjustments called increases and decreases to the basis of the property. The result of these adjustments to basis is called your adjusted basis. So examples of things that increase your basis include the cost of any additions or improvements having a useful life of more than a year, amounts spent after a casualty to restore damaged property, the cost of extending utility service lines to the property, and legal fees such as the cost of defending and perfecting title. Additions or improvements. Add to the basis of your property the amount an addition or improvement actually cost you, including any amount borrowed to make the addition or improvement. This includes all direct costs, such as material and labor, but never your own labor. Clients always like to see if they can claim a cost for their labor because they could have been making money somewhere else. But the money they could have made somewhere else is not money they did in fact make, and since they didn't make it, they didn't have to pay tax on it, so they have no basis in it. It also includes all expenses related to the addition or improvement. Examples of expenses related to an addition or improvement include: you had an architect drop plans for remodeling your property. The architect's fee is a part of the cost of the remodel. Or if you had your lot surveyed to put up a fence, the cost of the survey is a part of the cost of the fence. The cost of landscaping improvements. I had someone in my classroom who wanted to know, what about landscaping? So here we are. The cost of landscaping improvements is usually treated as an addition to the basis of the land, which is not depreciable. However, if the landscaping improvement is adjacent to the home rather than separate from it, then the landscaping may be depreciable, usually over a period of 15 years. Now, several years ago, I asked an auditor about this because it bothered me immensely. I'm teaching depreciation, and in depreciation on Appendix B, land improvements like roads and shrubbery and so forth are given a life of 15 years. But then you go over to the rental publication and it says you can't depreciate them. It adds to the basis in the land. So it seemed to be contradictory. So I called up this auditor and I said, well, how do you know when it's depreciable and when it's not? And his response to me was, you look at the house. If you were to take in a tractor and level the house, what would go with it? It would, obviously the deck attached to the house, the landscaping immediately around the house would all get flattened. You couldn't demolish the house with taking out all of the landscaping immediately surrounding that house. And on your typical city block with a 5,000 square foot house, it'd be pretty difficult to level any house on a 5,000 square foot lot without taking out all the landscaping and trees around it. Incredibly difficult to do that. It's expensive to do that, in other words. So most of the time, for most residential rental properties, that shrubbery and so forth around it is going to be adjacent to the house. But you could have a situation where you've got a rental property where you've got a good amount of land, lots of land, with land improvements, and then you've got a structure somewhere in the middle or on the edge, and is it possible to go in and level that structure without taking out all the shrubberies around it? And if it is, anything that would not be taken out is not considered to be part of the house and is non-depreciable. A new driveway leading up to a house. Well, roads and bridges are, well, I think roads are 15-year property. I wouldn't be so concerned about, they're technically, land improvements are not depreciable. Something that is considered to be an improvement to the house or to the structure on the house is, and that's what they're looking at as a difference. And I can see sometimes it's just going to be hard to know for sure. So you might have to be in a gamble zone sometimes. Now, this particular rule about adjacent to the home, I did finally find that in publication 527. It is in there. So it's not something I'm just taking verbatim from the mouth of the auditor. It's in writing. Also, assessments for local improvements. Assessments for items which tend to increase the value of property, such as streets and sidewalks, must be added to the basis of the property. For example, if your city installs curbing on the street in front of your house and assesses you and your neighbors for the cost of the curbing, you must add the assessment to the basis of your property. Also add the cost of legal fees paid to obtain a decrease in an assessment levied against the property to pay for the local improvements. You cannot deduct these items as taxes, nor may you depreciate them. Assessments for maintenance or repair or meeting interest charges are deductible as taxes. Do not add them to your basis in the property. Deducting versus capitalizing costs. You cannot add to your basic basis costs that are deductible as current expenses. However, there are certain costs you can choose to either deduct or capitalize. If you capitalize these costs, include them in your basis. If you deduct them, do not include them in your basis. The costs that you may be able to choose to deduct or capitalize include carrying charges such as interest and taxes, which you must pay to own property. Well, at the beginning of this discussion, I explained to you a situation where you would buy a house and not have it available for rent. And in that situation, you are required to capitalize the mortgage interest and taxes for that period of time. But there are situations where you could choose to capitalize rather than deduct certain costs. I normally see it done or associated with vacant land, not so much with income-producing property. Decreases to basis. You must decrease your basis in your property by any items that represent a return of your cost. These include things like amounts of any insurance or other payment you received as a result of a casualty or a theft loss, any deductible casualty loss not covered by insurance, any amount you received for granting an easement, any residential energy credit you were allowed if you added the cost of the energy items to the basis of your home, and the amount of depreciation you could have deducted on your tax return under the method of depreciation you selected. If you took less depreciation than you could have under the method you selected, you must decrease the basis by the amount you could have taken under that method. If you deducted more depreciation than you should have, You must decrease your basis by the amount you should have deducted plus the excess amount that you actually claimed. So if you don't claim depreciation at all, you'll be treated as if you did. And if you claim more than you're supposed to claim all that you actually did take. Okay. Basis of property changed to rental use. When you change property you held for personal use to rental use, for example, you rent your former home, you figure the basis for depreciation using the lesser of the fair market value or the adjusted basis. So fair market value, what is that? Well, that is the price of the property, or price at which the property would change hands between a willing buyer and a willing seller, both having access to all of the relevant facts and neither being forced to buy or sell. So that's what the market says it's worth, and it trades on the market at that price. That's the fair market value. In today's market, we do have a situation where we have people who have paid more for a house than it is currently worth. We have lots of people in that situation. And those people may be turning their properties into rental properties. They figure it's the only way they can afford to make the mortgage payment is just to get some income coming in, so they're turning them into rental properties. And now we as tax professionals have to figure a basis for depreciation. And in those situations, fair market value could be less than basis. If I pay $500,000 for a house in a not even fantastic neighborhood in California, just you know, $500,000 was getting you not so much in California not that long ago. Okay, and so I paid $500,000 for this house, and then 2 years later it's worth $250,000. Okay, and I'm making a decision, shall I short sale it? Shall I rent it? Shall I just walk away, abandon it, and let it get foreclosed on? What's the decision I'm going to make? So I decide I don't want a short sale, I don't want to foreclose, I'm going to rent it. So I turn it into a rental, and on the day I start renting it, what is my basis for depreciation? It's going to be the lesser of the fair market value at the time I turn it to business use or what I paid for it. And in this illustration, it's the lesser number. $250,000. So I have another illustration here in the manual where the fair market value is less than the cost. Several years ago, you built your home for $140,000 on a lot that cost you $14,000. Before changing the property to rental use last year, you added $28,000 of permanent improvements to the house and claimed a $3,500 deduction for a casualty loss to the house. Because land is not depreciable, you can only include the cost of the house when figuring the basis for depreciation. The adjusted basis of the house at the time of the change was $164,500. That is the amount it cost you plus improvements minus the casualty loss. So the house, $140,000, improvements $28,000, casualty loss negative $3,500, basis for depreciation $164,500. Now on the date of change of use, that is from personal to business, your property had a fair market value of $168,000, of which $21,000 was for the land and $147,000 was for the house. The basis for depreciation on the house is the fair market value at the date of the change, $147,000, because this is less than your adjusted basis of $164,500. Next up is maker's depreciation life under GDS. You can figure your maker's depreciation under the general depreciation system in one of two ways. The deduction is substantially the same both ways. The difference, if any, is slight. The first way is you can compute the deduction using the depreciation method and convention that applies over the recovery period of the property. Now, during my Depreciation Made Easy class, I showed you how to do that. We actually spent some time manually figuring depreciation. And IRS says you can do that. The other way you can do it is to use the percentage from the optional maker's tables. Now, the thing is, the maker's tables and the manual method are going to be off by a few dollars because the maker's tables do rounding in a different way than you might actually get by manual calculations. But that's okay. IRS says either way is fine. One of the things you should know is if you ever take a class of ours that involves depreciation, our computer software grabs from the tables. So if you're doing a manual calculation on depreciation, you may come up with a different number than our software. And so we try to, like if we enter what is the amount of depreciation you claimed on a certain line, we might have 5 answers with each answer being $1 different than the answer our software came up just to account for that. But it is normal for software to round differently. Okay, and this table comes from publication 527. I thought it would be helpful and relevant to stick it in the manual for you today. It shows the maker's recovery periods for properties used in rental activities, and it shows the type of property that could be used in a rental activity and the depreciable life that property has under the general depreciation system and the depreciable life of that property under the alternative depreciation system, or ADS. What is most relevant in here is that appliances such as stoves and refrigerators do have a 5-year life when they are used for rental. But those same appliances, if they were used, say, in a commercial restaurant business, would be 7-year property. So the lives given to certain assets for rental purposes are different. Also, carpet is considered to be 5-year property, and furniture used in a rental property is 5 years, but that same furniture used in our tax business would be 7-year property, right? But office furniture is still 7-year. That's interesting. So if you have furniture used in the rental property, it's 5-year, but desks and files used in a business activity are 7 years. Fences, 15 years. Shrubbery, 15 years. Roads, 15 years. Any property that does not have a class life and is not being designated by law as being in any other class, in other words, you can't find a hole to put it in, it's 7 years. Unless you're depreciating under ADS, which is 12 years, ADS would apply to any foreign rental property. So if you have a rental property outside of the United States, you must depreciate under ADS, in which case most property is 12 years and the structure itself is 40 years. Shrubbery is depreciable or not depreciable depending on whether it's adjacent to the home or separate from the home. 5, 7, or 15-year property. For property in the 5, 7, or 15-year class, actually 5 or 7-year class, you use 200% declining balance. And if it's in the 15-year class, you use 150% declining balance. But for property that is in the 5 or 7-year class, you can choose to go 150% declining balance. So maker's accelerated depreciation is allowed on rental property. 5 and 7-year property used for rental purposes normally goes double declining balance or 200% declining balance. You can choose to go 150% declining balance instead. And then if it is 15-year property, it automatically falls under the 150% declining balance method. The special depreciation allowance, also known as bonus depreciation, you can claim bonus depreciation on assets placed in service in your rental if they have a class life of 15, 5, or 7 years. If the class life is longer than 15 years, I think certain 20-year property qualifies, but I can't think of any 20-year property in use in a rental. So let's say the structure itself is 27.5 years, or you put in a new furnace, that would also be 27.5 years. Those longer life properties are not eligible for bonus. But if in the property you replace the refrigerator, you replace the carpet, those are 5-year properties, normally eligible for 200% declining balance. You are allowed to claim bonus depreciation on those for tax years 2000 and, 9, 10, 11, and 12. And for part of 2010 and all of 2011, the amount of bonus depreciation you can claim is 100%. And for 2012, it goes back down to 50%. Now, do not confuse bonus depreciation with the Section 179 deduction. You are not allowed to claim a Section 179 deduction for property placed in service for rental purposes. And I could see that as being a good test question, whether you're on the Registered Tax Return Preparer exam or Oregon's Consultant exam or the C exam. You cannot use the Section 179 deduction for rental property, period. Bonus, yes. Section 179, no. Got it? Depreciation method and convention, you must use the straight line method and a mid-month convention for the residential and non-residential rental property itself. Line 19 is where you enter any other expenses that are not listed on lines 5 through 18. You may be able to deduct on this line part or all of the cost of modifying existing commercial buildings to make them energy efficient. Line 20 is where you total up your expenses. You then determine the amount of profit or loss on line 21. So now we're into this part of Schedule E. Line 21 is where you total up your rental income or loss for the year. If the total is a loss on line 21 and you have amounts you are not at risk for, complete Form 6198 to determine the amount of your deductible loss. Enter the amount in the appropriate columns of line 21. Now, in addition to 6198, which is used to determine whether or not you are at risk for your loss, we also have to look at the fact that rental property is by definition passive, and as a passive activity, your loss may be limited. And that's going to be the next topic we come up on is at-risk limits and passive activity rules for the last hour and a bit of our class today. Deductible rental loss, do not complete line 22, this line right here, if the passive activity loss is limiting you. So do not complete line 22 if the amount on line 21 is from royalty properties, and if you have a rental loss from a passive activity, the amount of loss you can deduct may be limited by the passive activity loss rules. You may need to complete Form 6582 passive activity loss limitations to figure the amount of loss, if any, that you can actually enter on line 22. So there are two reasons why you could have a number on line 21 that does not carry to line 22, actually three reasons. One is the loss is on royalties, can't claim it down here. Another one is that the loss is a loss you're not at risk for, in which case you complete Form 6198 to figure the amount of loss you are at risk for and enter that on line 22. But even after you determine you are at risk for your loss may be further limited under passive activity loss rules. And you would fill out Form 8582 to figure out how much loss, if any, you are allowed to claim. And you enter the allowable loss on line 22. Line 23 has all these new categories this year, A, B, C, all the way through G. Lines 23A and 23B, this is the total amounts from line 3A and 3B. Right now you leave them blank. You're not going to use line 23A or B in 2011. On line 23C, you enter the total of all amounts reported on line 4 for all rental properties. That's basically your total income from the rental properties for the year. On line D, you enter the total amount reported on line 4 for all of your royalty properties. So lines C and D are used to separate rental income from royalty income. Then on line E, enter the total amount reported on line 12 for all properties. That's the total amount of mortgage interest for the year. So remember, I keep harping on, you don't ever want to enter a number on line 12 up here. Let me get to line 12. Good grief, how hard can this be? There we are. Phew. Okay. Line 12, mortgage interest paid to banks, etc. See instructions. The instructions are enter interest that was reported on a 1098. Whatever amount was not on a 1098, do not enter on line 12. The IRS is going out of its way to total the amounts on line 12 and point them in your face again here on line 23. Mortgage interest that's not on a 1098 would go on line 13. Okay. Next one, we have line 23F, all amounts reported on line 18 for all properties. Well, what do you report on line 18? Depreciation. So they want all the total depreciation you're claiming for the year entered on line F. And finally, on line G, enter the total amounts reported on line 20 for all property. That is the total of all of your expenses. Line 24, you enter your income. Enter the total of all passive amounts shown on line 21, but do not include any losses. On line 25, you enter the total royalty losses from line 21 and total rental losses from line 22 and enter here. Line 26, total rental real estate and royalty income or loss. Enter the total rental real estate and royalty income or losses by combining lines 24 and 25. If parts 2, 3, and 4 and line 40 on page 2 do not apply to you, also enter the amount on line 26. So you're saying, okay, what happens on the other pages? Well, that's what we're going to talk about next, because the other pages have to do with passive activity income and other passive activity losses flowing through from K1s. K1s are issued by partnerships, estates, trusts, and S corporations. So there's essentially 4 different sources of K1s. And if you have a K1, that's a flow-through entity that comes through to your personal return as reported on Schedule E, page 2. And we're going to talk about some of those tax treatments today. A class I'm teaching on June 28 is all about S corporations and LLCs, essentially for preparing Form 1120S and Form 1065. And in those, we do the other side of the equation, which is actually filling out the K1s and showing how partners and shareholders will receive those. And we show a little bit how those tie into the 1040 there. But for today, we're looking on the receiving end. We've got the K1, our taxpayer brought it in, and what do we do with it? And also, how do we apply these at-risk rules? So you've figured out that you've got a rental loss. Are you allowed to deduct it? Your ability to deduct rental or royalty losses on Form 1040 may be limited by either or both of the following. The first one being the at-risk limitations, and the second one being the passive activity loss limits. Let's look at the at-risk rules first. Generally, you must complete Form 6198 to figure your allowable loss if the following is true. You have a loss from an activity carried on as a trade or business or for the production of income, and there are amounts in the activity for which you are not at risk. You must apply the at-risk rules before you apply the passive activity rules, which are discussed next in this course. At-risk is a pretty easy concept to understand. You're at risk under the tax law if you have money that you've paid tax on that's invested in something. So let's suppose you started up a business and it cost you $100,000 to start that business, and you put $100,000 into that business. And it's money that's after-tax money to you, or even money that you inherited. You are considered to have a basis in that money. You put it into the business. That is your basis in the business. Assuming you put no other money in the business, how much are you at risk for? $100,000. Now, how do you become less at risk? Well, you become less at risk as over time you claim deductions against that cost. So if that business generates a $100,000 loss and you claim that loss on your tax return, you are now no longer at risk because you've recovered that cost through losses claimed on your tax return. Now, sometimes it's possible to have ownership in a business that you're not at risk for because it's not your money that's invested in it. It could be that you're involved in a partnership and your partners have put all of the money in and you're not at risk for anything. You're putting your time in, you're putting your knowledge in, but none of your own money. And also you haven't contributed property to it. So you're not at risk for anything financially other than your lost time or your lost energy. And IRS doesn't recognize time or energy. We know that already. So you're only at risk for amounts that you put into a business, and amounts you are considered at risk for include the amount of money you contributed to the activity, the adjusted basis of property you contributed to the activity, and amounts borrowed by you and contributed to the activity. What are amounts borrowed? To be considered at risk for an amount borrowed, you must be personally liable for repaying the loan or have offered property as collateral for the loan. If you offered property as collateral, you are at risk for the fair market value of your interest in the property. Property offered as collateral for a loan cannot be used in the activity. Amounts you are not at risk for. You are not considered to be at risk in an activity to the extent you use non-recourse loans to finance the property. There is an exception for qualified non-recourse financing that we'll talk about. Or if the amount contributed or pledged to the activity are protected against loss by stop-loss agreements or guarantees, etc. Or for amounts borrowed for use in the activity that come from a person who is not a creditor but holds an interest in the activity. Note that a shareholder's interest in a corporation is not an interest in an activity of the corporation under this rule. So what's qualified non-recourse financing? Qualified non-recourse financing is financing for which no one is personally liable for repayment and is borrowed by you to hold real property, that is real estate, is secured by real property used in the activity, is not convertible from debt obligation to ownership interest, and is an amount loaned or guaranteed by any federal, state, or local government or borrowed by you from a qualified person. A qualified person is a person who actively and regularly engages in the business of lending money, such as a bank or savings and loan association. But a qualified person cannot be related to you unless the non-recourse financing obtained is commercially reasonable and on the same terms as loans involving unrelated persons, the seller of the property or a person related to the seller, or a person who receives a fee due to your investment in real property. So what they're saying here is, if you're not at risk for the money you've borrowed, you're not at risk in the activity for the amount of money you borrowed and put into the activity. What would be a good example? You borrow money to buy a house. The loan is secured by that house, and the only remedy is the house. If you default on the loan, the lender can repossess the house, but they can't come after you personally. That's a non-recourse loan. They have no recourse against you directly, only against the property you hold. They can't go above and beyond the property. And IRS says, in that kind of situation, you're not at risk for it. However, they say even if it is non-recourse financing, you're still at risk for it if it's the type of loan that's normally associated with real estate. That is, it's a loan taken out against the real estate. So let's look at a comparison. That loan taken out by the real estate is a non-recourse loan, but if the loan is taken from a commercial bank in the business of loaning money, you're still going to be considered at risk for it. But let's look at something that would be similar but not treated the same, and that would be an auto loan. You purchase an auto loan, and the loan on the car is secured by the bank, and there is no recourse against you other than repossessing the car. They can't come after you for it. That would be a very rare thing, because most of the time they'll repossess the car plus come after you, right? But let's just suppose we had a situation where it was non-recourse. There's a debt on the car. The only recourse the bank has is to repossess that car. You transfer that car into the partnership and want to increase your basis by putting that car into the partnership. Because it's a non-recourse loan, not against real estate, you would not be considered to have added to your risk in the partnership. You're not at risk for the car under those rules. So it's a very special definition associated with rental, well, not with rental, but associated with real estate. And when you have a loan on real estate and the loan is coming from a commercial lender, the loan is securing that real estate or secured by that real estate, even if there is no recourse against you directly, you're still considered to be at risk in that situation. Adjustments to risk, or adjustments to at-risk basis is next. The following adjustment items will affect your at-risk basis. Your basis will increase if you contributed additional cash or property to the activity, or you assumed additional qualified liabilities, or you received a share of taxable or non-taxable income from a pass-through entity, such as a partnership or S corporation. Profits of pass-through entities are passed through to partners and shareholders on Form Schedule K-1. Your share of income from these activities adds to your basis. Now your basis decreases if you received a distribution of cash or property from the activity, or you were relieved of a liability relating to the activity, or a recourse debt relating to the activity was converted to a non-recourse debt, or you shared in losses flowing through to you from your ownership interest in a pass-through entity such as a partnership or S corporation. So let's just suppose I have an S corporation and I'm $10,000 at risk in that S corporation. That's how much I put into it. And during the year, that S corporation has a loss, and my share of that loss is $3,000. That loss will flow through to me, and I claim that loss on my tax return. And because I'm able to claim that flow-through loss, my at-risk amount has now dropped from $10,000 to $7,000. I'm allowed to claim the $3,000 loss in full. The next year, I add no more money to the S corporation, and the S corporation realizes a $10,000 loss for my share of ownership. My loss will be limited to $7,000 because that's all I'm at risk for. And I have $3,000 of loss that will have to carry forward until a year or a time where I contribute additional money to the S corporation or the S corporation realizes income. Now the opposite of that last example is a profit example. I'm an owner in an S corporation and I put $10,000 into the S corporation. The S corporation produces a $3,000 profit that flows through to me as income on my tax return. But it doesn't actually give me the money. It can do that. Did you know that? It can realize that profit. I'll have to pay tax on that profit, but I don't get the money. And because I didn't get the money, my basis has now gone up by $3,000 because it's still in there. So I put in 10. The business realizes a $3,000 profit. I report that profit on my tax return. My basis is now $13,000. Now what happens if later in the year the S corporation distributes $1,000 to me? Well, that distribution now reduces my basis from 13 to 12. So these basis calculations are crucially important. I see basis, the concept of basis being something a lot of tax preparers and certainly clients don't get. That they see a number on a K-1 and it's a loss, they're going to put it on the tax return, no questions asked. But you need to be asking the questions. Has any kind of basis calculation been done? Now, over time, I have observed that the software we're using, I always talk about how we use Drake software, not because I'm recommending it, it just happens to be what we use. But the software that we use, over time, keeps adding more and more screens dealing with basis calculations. Apparently, it's been a problem. I don't know if it's a problem for them in specific, or it's been a problem in general, and the IRS is just pushing software providers to add these basis screens. But if you see a basis screen in your software, it's there for a reason. It's there to track your client's basis in their entity, and that should be something of great concern to you. Now, last year we had a client come into our office, and he had this K1 showing this big loss. First question we ask is, how much are you at risk for? So you've lost $50,000 here. How much did you put in? Well, I didn't put any in, but I get the loss. No, it doesn't work like that. Well, they told me. The CPA who did the return said, I get to claim that loss. And we're going, you can't claim a loss you're not at risk for. How are you at risk for it? Did you put money in? Have you borrowed money and put it in? Have you contributed property? No, but I'm told I get to claim that loss. So we were saying, you can't give us your basis. We can't give you any loss at all. You really need to tell us what your basis is. And the answer kept coming back, well, I have none, but you need to take it anyway. So our response was, well, no, we're not going to do it, and we refused. And so I'm not sure what it was, but as soon as we told the guy to take his stuff and leave, then he wanted us to do it our way. So we did it our way. This year, the same client comes in and he finds a new tax preparer. He seems to be trying to find the dumb ones in our office, see if he can get away with it. I don't know why he doesn't just try another firm entirely, but this year he came back, and he got one of my newer tax preparers, the poor guy, second-year preparer, and he was sitting there working on this, and this customer, he'd formed a single-member LLC to be an owner in the partnership for the sole purpose of somehow being able to claim this loss when he's not at risk again. And I was scratching my head, why would you form an LLC to be a member in another LLC, and you're the only member in your LLC, but you're filing a partnership return? You cannot file a partnership return when you are the only member of your LLC. That would be a sole proprietor type thing. They were just doing all of these weird things, all of them in an effort to create a semblance of risk when there was none. And after torturing my poor tax preparer came to me, and I was like, what is going on here? I didn't know this client had been to us the year before, but somehow the word started spreading in our office. We were talking about it, and one of my other preparers piped up, you remember that guy? I worked on him last year. The bottom line behind this story is there are people out there who are trying to create basis and see, or trying to create an illusion of basis to claim losses that they've never sustained. And as tax preparers, we need to be on the lookout for basis, understand basis, because you cannot claim a loss when you're not at risk. And in an audit, an IRS auditor will ask your tax client to show that they're at risk. If your client cannot show they're at risk, they will not be allowed to claim that loss. So at the tax preparer stage, our job is to inform our client they need to be at risk, to establish what their basis is, and to track that basis year to year. What causes basis to go up? Income that has been flowed through to them but not distributed to them. And money that they contribute, and property that they contribute. And what causes their basis to go down? Property that is distributed, money that is distributed, losses that flow through. Those are all things that affect basis and have to be tracked. So yes, question. There's a question, even a manager participating in the business? Well, what we're talking about here is a very different thing. Active participation in a business has nothing to do with your basis in the business. Okay? Basis is created by putting money in or paying tax on profits of the business that you then leave in. That's what creates a basis. We can carry losses forward that you can't claim this year. So let's look at this recapture rule. If your at-risk basis is less than 0, if your at-risk amount in an activity is less than 0, which is not allowed, you may be required to recapture previously allowed losses. The recapture amount is the lesser of the negative at-risk amount or the total amount of losses you deducted in earlier years minus any amounts previously recaptured. Activities covered by the at-risk rules. You are subject to the at-risk rules if you were involved in any one of the following activities as a trade or business for the production of income: holding, producing, or distributing motion picture films or videotapes, farming, leasing Section 1245 property, exploring for or exploiting oil and gas, exploring for or exploiting geothermal deposits, or any other activity not included in 1 through 5 that is carried on as a trade or business for the production of income. Rental property in a foreign country has no bearing on whether it goes on Schedule E or not. If the property is real estate and you are renting real estate in a foreign country, it is reported on Schedule E. And if you are renting real estate inside of the United States, it also goes on Schedule E. It's just that when you're dealing with, say, for example, depreciation, the depreciable life of foreign property or property outside of the United States has a different life than property inside of the United States. And if you're dealing with like-kind exchanges, property outside of the United States cannot be traded for property inside of the United States and receive like-kind treatment. But the time that you report rental income as ordinary income on line 21 of your tax return is when you are renting personal property and you're not in the business of renting personal property. And the illustration I gave was a horse trailer, for example. And whether you rent that horse trailer inside of the United States or outside of the United States, it's still line 21. Okay, Form 6198 asked risk limitations. Form 6198 is filed by individuals, estates, trusts, and certainly closely held C corporations. You must file Form 6198 if you are, if you or a partnership or S corporation in which you have an interest incurred a loss for the tax year and you had any amounts in the activity which were not at risk. Use Form 6198 to figure your current year profit or loss from an at-risk activity. In Part 2 or 3, you figure your amount at risk for the year, and in Part 4, your allowable deductible loss for the year is entered. So it's a 4-part form. Part 1, you use Part 1 to report current year profit or loss from an activity and to report losses or deductions from earlier years that you could not deduct because the at-risk rules limited or did not allow you to claim the loss. So let's just suppose you have a loss flowing through to you from your S corporation. The loss flowing through to you is $5,000, but you're not at risk for it, so you cannot claim it. You would enter that loss on Form 6198 and show that you're not at risk for it, and that loss will carry forward to the next year. And in the next year, you will determine whether or not you have contributed capital or perhaps that S corporation has now produced a profit that prior year unallowed loss can offset. In Part 2, you use Part 2 if you know what your adjusted basis in a partnership or S corporation activity is, and you simply enter it. Part 3 is a longer method of figuring your amount at risk. It may allow you a larger amount at risk than Part 2. If you complete Part 3, do not also complete Part 2. It's one or the other. And then finally, in Part 4, you figure your deductible loss. Use Part 4 to figure your deductible loss for the year. If the loss on line 5 is equal to or less than the amount on line 20, report the items in Part 1 in full on your tax return, subject to such limits as passive activity loss and capital loss limitations. And here is a detailed illustration of an at-risk situation. We have a character named Matt Dillon, who owns 50% of the S corporation Gunsmoke, Inc. Matt's basis in Gunsmoke at the beginning of the year was $20,000. During the year, he contributed another $15,000 to the corporation. Matt is also a guarantor for a $100,000 loan Gunsmoke currently has with First County Bank. Matt's K-1 from Gunsmoke, Inc. is shown below. Prepare his Form 6198. Well, here is his K-1, and you will see on line 1 it's showing an ordinary business loss of $50,000. The question is, how much is he at risk for? And here's the interesting thing about loans that are guaranteed by shareholders in the corporation. The IRS says that you are not at risk for money that you guarantee that is loaned to a corporation. You are at risk for money that is borrowed by a partnership that you guarantee, or a limited liability corporation or a limited liability company that you guarantee, but not for a corporation. So if you have an S corporation that takes out a loan and the bank asks you to co-sign as a guarantor of that loan, you are not at risk for that loan in term as far as the IRS is concerned when it comes to losses. And you can see that Gunsmoke, Inc. could trigger a loss greater than your cost because it borrowed this money, right? It's going to use this borrowed money to fund its loss. The question is, can you claim the loss? And the answer is, not in the case of an S corporation. If this were Gunsmoke LLC filing a 1065 K-1, yes, you would be at risk. It's just a peculiarity of S corporations. Why that rule is in place, there's probably reasons for it that I'm not going to get into, but for us here today, that's just the rule you need to know. So the message behind it is, if you have a tax client who owns an S corporation and that S corporation needs to have capital funded to it, and your client wants to be able to be at risk for that money that is being borrowed, then the thing to have happen is the S corporation shareholder should borrow that money in their own name and then loan it to the corporation. But if the corporation borrows the money directly with the shareholder as the co-signer, the shareholder who is the co-signer or guarantee of that loan is not at risk for it for tax purposes. And that's what's going on here with Matt Dillon. He is not at risk for any amount of loss other than the $20,000 he put in at the beginning and another $15,000 he contributed to the corporation during the year. So out of this $50,000 loss, he will be allowed to claim $35,000 this year. And let's take a look at his 6198 right here. So Matt's allowable losses cannot exceed his basis. We start off on line 1 of Form 6198 by entering the amount of loss showing on his K1, $50,000. We then go into Part 2 of the form and enter his basis at the beginning of the year, which is $20,000. On line 7, we enter the amount of capital he contributed during the year, and on line 8, we total that up. That is his basis or at-risk amount for the year. He has no other decreases for the year directly, so we have $35,000 as his at-risk amount. Therefore, $35,000 is the deduction he will be allowed to claim. And after he claims this deduction, his at-risk amount is now 0. So that would be part of the basis calculations we're tracking for him. He's going to have a $15,000 loss carry forward to the next year. And in that next year, he can either contribute more money, or possibly the corporation will realize a profit that can be used to offset that loss, but that has to be tracked year to year. Okay, now the second part of Matt Dillon's return is to complete page 2 of Schedule E, because this is a rental or a Schedule E class, isn't it? So we had to do something to make things happen on page 2 of Schedule E, and here it's happening. So we have the business activity, and this is an activity in which he is an active participant. That means he is not passive. IRS does not say you're active or passive. They say you're passive or non-passive. So non-passive is the same as active. Got it? All right, so on the back page of the Schedule E, page 2, we described the business name or entity name. In this case, it's Gunsmoke Inc. In this next column here, we indicate that with a code S that this is an S corporation rather than a partnership. And then we enter the employer ID number. And then it says, check if any amount is not at risk. Technically, I'm thinking we might have had to check that box. Then we go on to line H here. It's actually line 28, column H, where we enter the non-passive loss that is being allowed for the year, $35,000. And there's no other entries. You know, typically there probably might be some other entries on here, but for this illustration, keeping it simple, it's the only entry we have. We simply carry it all the way through the form until we get down to line 41, where we have our total allowed loss for the year. On line 17, we enter $35,000. This is line 17 of the Form 1040. We are allowed to claim that $35,000 loss. So where does that $15,000 unallowed loss live? Well, it lives in the books. It lives in the records. And it's our job as tax preparers and the client's job as well to remember this at-risk amount or this loss that has been disallowed under the at-risk rules and carried forward to a future year. Now, if you have a client that's jumping tax services, moving from one accountant to another, one tax preparer to another, and you are the tax preparer that is now acquiring this client, that's one of the things to be looking for is back year 6198s and back year 8582s, where you're going to be looking for losses that have happened in other earlier years that could not be claimed because of the limits, and then factoring those into the current year. I can see that those are things that would easily get lost or dropped that need to be tracked. So the next topic now we're moving on to is passive activity loss limitations. I would say that I run into the passive activity limitations more often than I run into the at-risk limitations, but they're both equally important. You can't think about one only. You always have to be thinking about both. Rental real estate activities are generally considered to be passive activities, and the amount of loss you are allowed to deduct in a passive activity is limited. There's a little bit of a historical perspective I've put in here. I just love history. I love to understand what led up to an event. And essentially what happened was prior to 1986, a taxpayer could generally deduct losses in full from rental activities and from trades or businesses, regardless of his or her level of participation. There was a great incentive in those days to figure out ways to lose money with hobbies, for example. My hobby farm. You know, I might be a rich person who could afford fancy thoroughbred racehorse breeding facility. And I really have no investment in it at all other than my money. I'm not involving my time in it, my energy in it. It's totally operated by other people, and because it's horses, it eats money. Like it's going out of style. And so obviously Congress at that time said, well, you know, rich people are finding ways to lose money on things that interest them. You know, for maybe some future ambition that maybe one of the horses they're breeding is going to make a lot of money, we don't think they should really be allowed to claim these losses the way they have been. And so they passed a new law under the Tax Reform Act of 1986, and it added Section Code 469. 469 limits a taxpayer's ability to deduct losses from businesses in which he or she does not materially participate and from rental activities. Now, beginning in 1994, there is a relief provision relating to rental real estate losses. It now allows taxpayers who are real estate professionals who spend most of their time in real property trades or businesses to claim their losses. The new provision allows certain taxpayers to deduct current losses from rental real estate activities in full without regard to any passive loss limitation. Scope of the rules. The passive activity loss rules are generally applied at the individual level. Although Internal Revenue Code Section 469 was enacted to discourage abusive tax shelters, its impact extends far beyond shelters to virtually every other business or rental activity, whether it is reported on Schedule C, F, or E, as well as to flow-through income and losses from partnerships, S corporations, and trusts. But generally, the law does not apply to regular C corporations, although it does have limited application in closely held C corporations. Now, if you really want a gripping read, there is a link in here where you can go read the code in its entirety. Even I have not done that. Categories of income and loss. The Internal Revenue Code divides income into two categories. Passive, which includes rental and businesses without material participation, and everything else. Non-passive includes businesses in which the taxpayer materially participates. It also includes salaries, guaranteed payments, 1099 miscellaneous compensation, income and portfolio or investment income are deemed to be non-passive. So essentially, everything is non-passive except that which is passive. What's passive? Rental income and any business in which you do not materially participate. And do you think in auditors, one of the first things they're going to be doing when they're doing their questioning phase with a client is to figure out whether they're passive or non-passive? Believe me, it is. This year I had a man come to me. He bought a boat, harboring it down in the Seattle area, a yacht. And he figured it would be a good investment because, you know, boats are expensive, but that maybe the maintenance on the boat could be paid for if he started renting it out. And in addition to that, it might make some money. But of course, it didn't make very much. Now, he hired a company down there that is in charge of leasing these boats out to find people to rent them to and to collect the revenue and so forth. And he himself would, on the weekends, drive from Portland, Oregon to Seattle, which is roughly a 3.5, 4-hour drive one way to work on this boat. And he realized a loss, a big loss. And he claimed it on his tax return, which he prepared for himself. And because there was a big loss on his tax return, he was triggered for an audit, and he got to go downtown to the Portland office and talk to people there about it, the Portland IRS office. And while he was at the IRS office, the auditor started asking questions like, how many hours do you think you put into this activity? And the client had absolutely no idea why he was being asked that question, so he sat there. He had no clue how many hours he'd put in. Just pulled a number out of his hat. 300 hours, he said. Sorry, the losses are not allowed, she said. So you might be asking, what should he have said? 500 is the magic number, actually. And when he and I met and we discussed the 500, because she never revealed to him what the magic number was, she only told him 300 was not enough. He did not know what was enough until he came to me. And when I told him what the magic number was, he said, I need to go home and figure out how much time I really did put into that. I never saw him again. He disappeared with this full intention of adding up his hours, but at one point he did call me or email me and tell me, I put way more than 500 hours into this. So he was creating a log to figure it all out. So that is a key fundamental thing. How many hours did I put into that activity? How much time did I put into that activity? Because the amount of time I put into that activity will establish whether it is passive or non-passive. But by nature, rental property is always passive. So even if you put all of your time, full time, into managing your rental properties, they are always passive. So what is passive income? Well, passive income is generally income generated by a passive activity in the ordinary course of a business. There are two kinds of passive activities. Rentals, including both equipment and rental real estate, regardless of the level of participation, and businesses in which the taxpayer does not materially participate on a regular, continuous, or substantial basis. What is a non-passive activity? Income and losses from the following activities are generally considered to be non-passive. Salaries, wages, and 1099 miscellaneous income, guaranteed payments, royalties derived in the ordinary course of business, sole proprietorship or farm in which the taxpayer materially participates, partnerships, S corporations, and limited liability companies in which the taxpayer materially participates, trusts in which the fiduciary materially participates, pension or annuity income, lottery or gambling winnings. These are all non-passive forms of income or non-passive activities. Portfolio income is non-passive income. Portfolio or investment income is income typically reported on Schedules B or D. Portfolio income includes income from interest, dividends, capital gains and losses, including gains or losses from stocks and bonds, sale of undeveloped land or other investment property. So how do passive activity loss limitations work? Well, generally, losses generated by passive activities can only be used to offset income generated by other passive activities, except and until disposition of a taxpayer's entire interest in a passive activity. Losses from passive activities cannot offset non-passive income from wages or salaries, portfolio or investment income, or profits or income from sole proprietorships, farms, partnerships, or S corporations in which the taxpayer does materially participate. In other words, a taxpayer cannot deduct losses from passive business activities and rentals unless he or she reports other passive activity income on the tax return against which those losses can be offset. Whew, that was a mouthful. So let's take a look at an illustration. We have a loss from a passive activity. Luke is a 40% owner in Yemen Inc., an S corporation. The daily business activities of the corporation are carried out by employees of the corporation and by other shareholders. Luke's participation is limited to the money he has invested in the corporation. During the year, Yemen Inc. incurred a $25,000 operating loss. Luke's distributive share of the loss is $10,000. Luke will not be able to claim this loss on his personal return unless he has other net passive income from another passive or rental activity. If Luke has no other passive activity income, he must carry his loss on Yemen Inc. forward each year until he either has passive activity income or disposes of his entire interest in Yemen Inc. Also, passive activity credits. Earlier today I mentioned the disabled access credit. That would be an example of a credit that you might claim in a passive activity. If your passive activity is generating a loss and you have a credit against that same activity, you're also not going to be able to claim the credit. But you can subtract passive activity credits only from the tax on net passive income. If you have no tax on passive income, the credit is disallowed and carries forward. Credits that are more than tax on income carry forward each year. Exception for active participation in rental real estate activities. Even though rental real estate is a passive activity, you may be able to deduct up to $25,000 of loss on rental real estate if you actively participate in managing the rental real estate. Active participation is a lower standard than material participation. You meet the active participation test, or rather if you do meet it, You are allowed to deduct up to $25,000 of loss per year. You are limited to half that amount if your filing status is married filing separately and you did not live with your spouse at any time during the year. If your filing status is married filing separately and you lived with your spouse at any time during the year, you are not allowed to claim any loss at all. Now, having said that your loss could be as much as $25,000, the allowed loss decreases or phases out when your adjusted gross income exceeds $100,000. It phases out at a rate of 50 cents on the dollar. So when your adjusted gross income is $100,000 or less, the loss can be allowed in full. And by the time your income reaches $150,000, no loss is allowed at all. This is a number that has never been adjusted for inflation in the 20 years I've been doing taxes. So over time, I'm finding more and more of my clients are phasing out on the rental losses and not being allowed to claim them. And they're sustaining that rule each and every year for many, many years in a row, keep having to carry forward these losses because their income is too high. Modified adjusted gross income. For purposes of passive activity losses from rental real estate activities, your modified AGI is your AGI from line 38 of your Form 1040 figured without taking into account a bunch of different things. Your software is probably figuring your modified adjusted gross income for you. I'm not going to read these items to you because you'll never remember them anyway. But it is not simply your adjusted gross income. Your modified adjusted gross income, for example, will not take into account any loss you're sustaining on the rental property. So you throw out that loss, you throw out a few other things as well to figure out what your income is. And if that modified AGI is over $100,000, you phase out, and if it's over $150,000, it's lost entirely. What does active participation mean? An active participant, or to be an active participant, both of the following rules apply. You and your spouse owned at least 10% of the rental property, and you made management decisions in a significant and bona fide sense. Management decisions include approving new tenants, deciding on rental terms, approving expenditures, and making similar decisions. So you can still be an active participant even if you employ a property management company, as long as the property management company needs to come to you to approve a repair, for example, or to approve a tenant. So you're making decisions about the property you're involved in. Now, this $25,000 limit and this income limit that we talked about, the $100,000 to $150,000 limit, there's an exception to that limit for real estate professionals. For any portion of the year that you were a real estate professional, your losses from active management of your real estate or your rental real estate are not passive activity losses in terms of the limits. A real estate professional who owns and manages rental property is deemed to have non-passive income from the rental activity. As such, the rental real estate professional meets the material participation rule, and his or her losses on rental activities are not limited by the rules relating to passive activity losses. So who qualifies as a real estate professional? To qualify, both of the following requirements must be met. Number one, more than half of the personal services performed during the year in all trades or businesses for the year were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of services during the year in real property trades or businesses in which you materially participated. We did have a cute situation in our office not that long ago where a client who worked full-time for Intel was trying to insist he was a real estate professional, that he put in more than 750 hours during the year. But now we know for a fact that Intel doesn't let anyone off for 40 hours a week. Okay, Intel works their people pretty hard. They do get a few vacations in, but physically, we knew it was impossible for him to work full-time in a high-paying job with Intel, plus be a real estate professional by these definitions. Maybe he could justify the 750 hours, but there was no way we were going to believe it was more than half his working hours were put into the real estate activity. So it's just those two rules both have to be met. You have to be on top of it. He would have had to work more than 40 hours a week at the real estate activity to be able to show that more than half of the personal services he performed during the year were in real estate. So that this first test here is probably harder to meet than the 750-hour test. So you're looking at someone who makes their living in real estate. That's what they do for a living full-time. That's their job. Not someone who does a little bit of real estate on the side as an adjunct to their main source of living. So what is a real property trader business? Your business is a real property trader business if it does any of the following with real property. Develops it or redevelops it. constructs it or reconstructs it, acquires it, converts it, rents or leases it, operates or manages it, or brokers it. Real estate professional election to treat all interests as one activity. Now, we know when we're doing tax returns that we are supposed to have a separate column on Schedule E for each activity. There's room on Schedule E for 3 of them, and if you run out of room on the first Schedule E, you add more Schedule E's and you keep listing each property separately. But real estate professionals can make an election to treat all of the properties as a single activity. And why would they do that? Well, it would mean keeping one profit and loss rather than multiples for each property. Now, frankly, personally, I think someone who's really managing their properties well will want to keep a separate profit and loss for each one anyway, just to track how well each one is doing. But you could see book-wise, bookkeeping-wise, lumping them all together might be easier. But also, when you lump activities together, losses occurring on one property can be offset by profits by another property. They're kind of all melded together, and that can be a good thing for simplicity and also for certain tax rules. Now, a real estate professional can make that election to combine the activities. If they do that, the choice is binding for the tax year you make it and for any later year that you are a real estate professional. The choice will continue to apply to years where you are not a real estate professional. However, for any year you are not a real estate professional, the rental activity will be subject to the passive activity loss limits. Grouping is important because if the activities are separate, you must show material participation in each one. If the activities are grouped, you will only need to show participation in all of the activities as a whole. Okay. Here is an illustration of Schedule E for a real estate professional. Here we've given a single address. However, we've got a large enough amount of money here you can show that it's a lumping. And we've got $100,000 of rental income. We've listed all of the expenses. They exceed the income, so when we get down to line 22, we have a loss of $29,180. And normally we wouldn't be allowed to enter a number larger than $25,000 on that line. But because we're dealing with a real estate professional, we're allowed to claim that loss in full. And it is not going to be limited regardless of this taxpayer's income. And essentially, we also have to fill out page 2 of Schedule E. Down at the bottom in Part 4, there is a summary where you enter your total income or loss. And on line 43 is a reconciliation for real estate professionals where you identify yourself as a real estate professional, enter that loss in full, carry it to line 41, and then on to the 1040, and you enter the whole amount. Now, if you are making the election to be treated as, have all rental activities treated as a single activity, you have to attach an election statement to your return. I elect under Section 469C7A to treat all of the activities as a single activity. The election must be made properly to be accepted by IRS. What is material participation? When are you deemed to be having material participation in an activity? Generally, a passive activity is any rental activity or any business activity in which the taxpayer does not materially participate. Non-passive activities are businesses in which the taxpayer works on a regular, continuous, and substantial basis. In addition, passive income does not include salaries, portfolio, or investment income. A trade or business activity is not a passive activity if you materially participated in the activity. The Internal Revenue Code maintains material or defines material participation as regular, continuous, and substantial participation by the taxpayer. Determining whether an activity is passive or non-passive is done on an activity-by-activity basis and at the 1040 level. A taxpayer is generally deemed to be materially participating if he or she works more than 500 hours in an activity during the year or performs substantially all of the work in a business. Now, this is looking at the definition of material participation in general with passive versus non-passive activities. Real estate professionals move beyond that. Their tests are stronger. So you can have an activity that you are deemed to be non-passive in, even though you work at it part-time, as long as you meet that 500-hour rule. It is only real estate agents who want to be able to claim losses on rental real estate who are set to this higher standard of 750 hours in the year, plus being able to show it is the majority of their work during the year. But in general, it is possible to have a full-time job working 40 hours a week back at Intel and have another activity, a business activity, in which you are active and material because you contributed at least 500 hours during the year. That can happen. So the man with the boat, if you wanted to call that a business, and he was able to show it was a business, and he was in it for a profit motive, if you could show he had 500 hours in it, then he's deemed to be materially participating. Now conversely, if a taxpayer works 500 hours or less during the year, or works 500 hours or less during the year, or does not perform most of the work, losses are not allowable unless he has passive income. So the IRS has a series of tests to help establish whether or not you have material participation. You are considered to be materially participating if you pass any of the tests, just one of them, and there's a bunch of them. It only takes one. The first one is more than 500 hours of participation. If you participated in the activity for more than 500 hours, you are materially participating. Number two, your participation was substantially all of the participation. You provided virtually all of the participation in the activity. Under this test, little or none of the participation can come from any other owner of the activity or from any employee of the activity. So let's just suppose you own a business and you worked at it 300 hours during the year, but you're the only person who worked in the business. No one else worked in it. So even though you worked less than 500 hours, you're still considered to be material because you're the only one who did the activity. The next one is more than 100 hours and majority of participation. You participated in the activity for more than 100 hours during the year, and you participated at least as much as any other individual, including individuals who did not own any interest in the activity. The next test is significant participation. If you have more than one activity, you meet this test if you participated in all activities for more than 500 hours during the year, and you participated in each activity for more than 100 hours during the year. Test number 5, material participation in the activity for any 5 of the 10 immediately preceding tax years. If you materially participated in the activity for any 5 taxable years during any of the 10 immediate preceding years, then you are considered to be active in this year. Number 6, the activity is a personal service activity for any 3 preceding tax years. Doesn't even need to be in the last 10 years, ever. In 3 preceding years in history, you were active. Then for all succeeding years, you continue to be active if it was a service activity. Examples of service activity include personal services in the fields of health, including veterinary services, law, engineering, architecture, accounting, actuarial service, performing arts, consulting, or any other trade or business in which capital is not an income-producing factor, capital being money. Number 7, you participated in the activity on a regular, continuous, and substantial basis during the year. You did not materially participate in the activity under this test if you participated in the activity for 100 hours or less during the year. Your participation in managing the activity does not count in determining whether you materially participated under this test if any person other than you received compensation for managing the activity, or any individual spent more hours during the year managing the activity than you did, regardless of whether that individual was compensated. Participation, in general, any work you do in connection with an activity in which you own an interest is treated as participation in the activity. Work not usually performed by owners. You do not treat the work you do in connection with an activity as participation in the activity if both of the following is true. Number 1, the work is not work that is customarily done by the owner of that type of activity, or your main reason for doing the work is to avoid disallowance of any loss or credit from the activity under the passive loss rules. So in other words, what they're saying there is you have to be legitimately working the activity. You have to be in it for the business, and you're doing it to make money. And you can't be making up fake work just to show you spent time at it. Okay, it has to be legitimately associated with the activity. Participation as an investor. The type of work that you do as an investor, such as studying and reviewing financial statements or reports on operations of the activity, or preparing or compiling summaries or analyses of the finances or operations of the activity for your own use, and monitoring the finances of the activity, are not considered to be material participation. And here is the spouse's participation question in the classroom we had. Well, what if the spouse works 710 hours, and what if you work 750 hours? Essentially, the rule is if your spouse participates in an activity, your participation in the activity includes your spouse's participation. This applies even if your spouse did not own any interest in the activity and you and your spouse do not file a joint return. Sale of a passive activity. You may generally deduct any prior year suspended losses and current year passive losses if you dispose of your interest in the activity during the year. This applies if you dispose of your entire interest in the activity and you do not make the sale to a related party. Now, an exception to this rule is sale of publicly traded partnerships. They are handled quite differently, and I covered sale of publicly traded partnerships in my sale of assets class. Illustration, sale of interest in a passive activity. Donald Duck disposed of his entire interest in Daisy LLC in a sale to an unrelated party. Donald is a passive partner in the business and had $13,000 of prior year suspended losses. His current year passive income is $5,000. Donald has no other passive income for the year, passive income or loss for the year. Complete his Schedule E, page 2, as shown next. So he sold all of his interest in the activity. He had a $13,000 loss coming into 2011, and this year it generated $5,000 of income. So what he does is he subtracts the prior year suspended loss of $13,000 from the current year income of $5,000. And because he disposes of his entire interest in the activity in 2011, he will enter the allowable $8,000 loss in the passive loss column. It says passive loss allowed, $8,000. He'll carry that $8,000 loss all the way down to line 41 and then smack it on line 17 of his tax return. Dispositions other than by sale. If you dispose of your property other than by sale, additional rules apply as follows. Under an inheritance, suspended losses are reduced by stepped-up basis. Excess losses are claimed on the final return of the decedent. Like-kind exchange. Your suspended losses remain suspended losses on the new property acquired. However, suspended losses are deductible to the extent of any taxable boot you received from the exchange. Installment sale. Suspended losses are deductible each year a gain is realized. Sale to a related party. Your suspended losses remain suspended losses until such time as the related party sells the property to an unrelated party or you have other passive income. Divorce. If you transfer property in a divorce, your suspended passive losses associated with the activity are transferred to your spouse. Your spouse who receives the property will add the suspended losses to his or her basis. Passive activity changes to non-passive activity. If you become active in an activity where you previously were passive, your prior year suspended losses remain passive. Suspended losses may be claimed to the extent of income produced by the activity plus income from all other passive activities. So you have a passive loss in activity, you become non-passive in that activity. It doesn't turn your prior year passive losses into non-passive loss. They retain that same character. Unallowed passive activity credits. If you claimed where you could not claim a credit in an earlier year because of the passive activity limits, and then you sell that activity, you do not claim the credit in the year of the sale. You do instead add that credit to your basis in the activity. So here is an example. Richard Boone disposed of his entire interest in the passive activity Paladin LLC. He has prior year unallowed disabled access credit in the amount of $2,000. Richard can elect to increase his basis in Paladin LLC by $2,000. So it will reduce his profit, but he doesn't get to claim the credit, which would clearly be a better deal. Activities that are not passive activity. The following are not passive. A trade or business activity in which you materially participated. A working interest in an oil or gas well which you hold directly or through an entity that does not limit your liability. The rental of a dwelling unit that you also used for personal purposes during the year for more than the greater of 14 days or 10% of the number of days during the year that the home was rented at fair value. An activity of trading personal property for the account of those who own interests in the activity. And number 5, rental real estate activities in which you materially participated as a real estate professional. We're just about out of time on this class, but I think we're going to be able to fit in the final couple of points I wanted to make. And those start with rental income that is reportable as self-employment. Yes, we are really close to the end here. If you provide significant services that are primarily for your tenant's convenience, such as regular cleaning, changing linen, or maid service, you do not report your rental income on Schedule E. Instead, you report your rental income and expenses on Schedule C, profit or loss from business. Rental income from real estate and personal property leased with real estate is not included in earnings subject to self-employment tax unless either of the following applies to you. You are a real estate professional or you provided services to your tenants. Real estate professionals. Real estate professionals are kind of confusing because a real estate professional can bring income in from a rental property in two ways. The first way is they purchase rental property to be a passive activity as an investment over time. And they have tenants. They have no intention of selling it. It's not a part of their rental real estate business. They just own the property. So this is a real estate agent. Now, if in addition to owning a rental property as an investment held long term, that real estate agent also purchases property, rents them while he holds them for sale, and then sells them. The IRS wants you to differentiate between those two situations. To the extent that a real estate professional owns rental property as a passive activity, those passive losses, if they have them, are going to be allowed because they are a real estate professional. The question is, when does that real estate income or loss move off of a Schedule E and onto a Schedule C? It belongs in a Schedule C if the income derived from it or the loss derived from it is part of the ordinary business of being a real estate agent. That I'm in the business of buying and selling properties, or I'm in the business, I'm in the business of helping other people buy and sell properties, and while I'm doing it, I come across a property that I think I want to buy, keep for a few weeks, fix up, and sell. And maybe when I've got it on the market, I put a tenant in it, or maybe it already had a tenant in it while I'm doing all of this trading. And in that kind of situation, the rental income and expenses would be includable in the income on Schedule C. Now also you include on Schedule C income if you are a trailer park owner and you provide services to tenants on your trailer park lot that are above and beyond the normal types of services that would be provided to a tenant. So examples of services that are not normally provided to tenants include supervising and maintaining a recreational hall provided by the park, distributing a monthly newsletter to tenants, operating a laundry facility, or helping tenants buy or sell their trailers. Examples of services that are not normally provided to maintain the lots in a condition for tenant occupancy include city sewerage, electrical connections, and roadways. Hotels, boarding houses, and apartments. Rental income you receive for use or occupancy of hotels, boarding houses, or apartment houses is subject to self-employment tax if you provide services for the occupants. Generally, you are considered to provide services for the occupants if the services are primarily for their convenience and are not normally services provided for the rental of rooms for occupancy only. An example of a service that is not normally provided for the convenience of occupants is maid service. Examples of services that are normally provided to tenants include providing heat and light, cleaning stairways and lobbies, and collecting trash. And the final form I'm going to show you today is Form 4835. This is the farm rental income form. I mentioned it way at the beginning of class. You use this form if you are a landowner or sublessor and did not materially participate in the operation of a farm. You report farm rental income that you receive based on produce, grains, other crops, or livestock produced by the tenant. Under both the cash and accrual methods of reporting, you must report livestock or crop share rentals received in the year that you convert them into money or its equivalent. Do not use Form 4835 if you were a landowner and materially participated in the operation or management of the farm. If that was the case, you need to file Schedule F because, well, you're a farmer.
Password number 3 is EMU. E-M-U. EMU.
All right, so that concludes the lecture portion of the class. I do have a classwork assignment here for you guys, and we, of course, never had time to get to it. That's normal with me. I have too much information. But for those of you who are webinar students and you want to really take a look at a good illustration where I combine everything we talked about in class today, including Schedule E, Schedule E page 2, 4562, 6198, and 8582, all onto one return, this is it. You can read through it and then look at the answer key.
And it is now time to complete the classwork assignment for session 19. And this assignment involves preparation of a Schedule E. Finally, you're going to do the whole thing, start to finish, and not just little bits of it as we've had in earlier sessions. And the forms you need to complete for this assignment are 1040, Schedule E, Schedule E page 2, Form 4562, Form 6198, and Form 8582. The character in this story is Rudolph Deer. He bought a condominium apartment to live in. And instead of selling the house he had been living in earlier, he decided to convert it to a rental property. Rudolph selected a tenant and started renting the house out on February 1st. Rudolph charges $1,200 a month for rent and collects it himself. He also received a $1,200 security deposit from his tenant, which he plans to return at the end of the lease. Rudolph had the following expenses for the year, including mortgage interest of $8,500, fire insurance, a one-year policy costing $200, miscellaneous repairs of $350 that he paid after he started renting the property, real estate taxes of $2,000, and auto expenses using the standard mileage rate. He had 250 miles, all driven prior to July 1, and then 12,500 other miles. Rudolph bought this house back in 2001 for $10,000. $33,000 was allocated to land value, and $67,000 was towards the value of the house. Before changing the home to rental property, Rudolph made the following improvements. He remodeled the kitchen for $5,000. He installed a recreation room costing $5,000. He added a new roof at a cost of $1,500 and built a patio and deck for $3,400. On February 1st, Rudolph changed his home to rental use, and at that time the property had a fair market value of $150,000, of which $50,000 is for the land and $100,000 for the house. So when we convert personal use property to business use, the cost basis that Rudolph uses is the lesser of fair market value or his cost basis on the date of the conversion to business use. So he paid $100,000 for the house, and on the conversion date it's $150,000. Therefore, we're going to go with his cost basis plus the cost of improvements. On April 1st, 2011, Rudolph bought a new dishwasher for the rental property at a cost of $450. The dishwasher is personal use property used in a real estate activity and has a 5-year recovery period. He uses the half-year convention to figure his depreciation deduction for the dishwasher. We're not going to have you claim bonus on that dishwasher. We're just going to have you claim 5-year depreciation. On June 1, 2011, Rudolph also installed a new central air conditioner and furnace into the house. The cost of the units and installation was $4,500. The AC and the furnace are residential rental property that do have to be depreciated over 27.5 years. So here we have a depreciation schedule for Rudolph Deer. We have the rental house that has a placed in service date of February 1st, 2011. The life is 27.5 years. His basis for depreciation will be the purchase price of the house plus the cost of improvements minus the value of the land, and that gives us $81,900. And his current year depreciation is going to be $2,606. The dishwasher and the air conditioning furnace system were placed in service after the property was placed in service, so those items are spelled out separately on the depreciation schedule. We can see the dishwasher has $450 of cost, 5-year recovery property under a 200% declining balance method. That gives us first year depreciation of $90. And for the heating and air conditioning system, we have a depreciable basis of $4,500, 27.5 years straight line mid-month convention, giving us $89 of first year depreciation. And of course, the land is living separately on the depreciation schedule at a cost of $33,000, but it is not a depreciable asset. No depreciation is claimed. So the total depreciation that Rudolph will be able to enter on his Schedule E is $2,785, but because he has 3 separate assets that were placed in service for use in his rental property during the year, he's going to need to complete a Form 4562 as well. And don't forget, when you're completing the 4562, that there is space on page 2 that is provided for mileage information on his vehicle, and you will need to complete page 2 of that form. Rudolph received a W-2 and 2 Schedule K-1s, as shown next in this problem. Rudolph is a passive partner in Reindeer LLC. His capital account is accurately reflected on Form 1065, Schedule K1. And then Rudolph is an active partner in Toy Makers, Inc. Rudolph's capital account at the beginning of 2011 in Toy Makers, Inc. was $0, and during the year he contributed $2,000 to the business. Go ahead and prepare his return. So we have a W-2 for Rudolph showing $50,000 of wage income, $5,000 of federal withholding. And here we have the first K1. This is for a 1065. That means he is a member in the LLC. The loss showing on the Schedule K1 is $10,000. We also show you here on Schedule L that he has $20,000 beginning capital account. His current year decrease is $10,000, leaving him a year-end capital account of $10,000. But we do have to pay attention to whether he is passive or non-passive in the activity. He will only be allowed to claim a loss if he is active in the partnership or if he has other passive income to offset the loss. So we're telling you in the wording of the problem that he is a passive partner. That means he is going to be limited to the loss he's allowed to claim by the passive activity loss rules. And you're going to have to figure any other passive activity income he has, and you will be able to claim a loss on Reindeer LLC to the extent he has other passive income. And the only other passive income he might possibly have is a profit off his rental, so you need to establish if he has a profit on the rental. Now, Rudolph's capital account at the beginning of the year in Toy Makers, Inc. is $0, but during the year he added $2,000 to the business. He is an active partner or shareholder in Toy Makers, Inc. And here is the K1 for Toy Makers, Inc. You can see it's from Form 1120S. It has a loss of $5,000, so the important thing to remember is that his loss cannot be more than his basis. He starts the year at 0. He adds $2,000. That means he's going to be allowed a $2,000 loss, and he's going to have a carry forward on the remaining $3,000. So your job at this point is to push pause on video playback and complete Rudolph's tax return. When you are finished completing Rudolph's tax return, please resume video playback for a review of the answer key. And I have up on the screen in front of you now the answer key for the Session 19 classwork assignment. And let's just cover a general overview of the problem. I gave you a lot of information in this problem. Rudolph has a W-2, which is pretty simple, but we threw a couple of Schedule K-1s at you and a more complex rental property assignment. In the wording of the problem for the assignment, let me just scroll to that now. I told you that Rudolph selected a tenant and started renting the house on February 1st, and that he charges $1,200 a month for rent, and he collects it himself, and that he also received a $1,200 security deposit from his tenant that he plans to return at the end of the lease. So a refundable security deposit that is taken in by a landlord is not income to the landlord. It would only become income to the landlord when it is forfeited. So Rudolph collected $1,200 of deposit. He does not include that in income. So how much income does he have? Well, he rented the house for 11 months, February through December, at a rate of $1,200 per month. So you simply go 1,200 times 11, and you're going to get the amount of rental income that he had. Now, why didn't I just tell you how much rental income that he had? Why am I making you think through it and figure it out? And the answer is because our clients almost never bring in a total on rent. They come in and they say, well, let me see, I rented it for 6 months for $500 a month, and then I rented it for 4 months at da-da-da per month. That's how clients think. And so knowing how clients think, I've created a problem that is basically worded to make you think in a way that you should be processing information as it is delivered to you by the typical client. And so ultimately, 11 times 1,200 is the amount of rent that Rudolph will report for the year. Now, even though Rudolph occupied the property for more than 14 days during the year, he is not going to treat any portion of the time he lived in the property as a day of personal use. The day of personal use rule is really referring to a property that is a rental property, which is being used for personal purposes while it is being held for rent. And in Rudolph's case, it was his personal residence. He converted it to rental, and from the point he converted it to rental, there was no personal use. So we're going to say that there are 0 days of personal use in the property. Figuring depreciation, we gave you all of the information on the depreciation schedule already, but we've got it again here for you. The house has a cost basis of $67,000. Where do we get that? We take $100,000 of purchase price and subtract out the land value of $33,000. That leaves us $67,000. We then add in the remodeled kitchen, the rec room, the new roof, and the patio. When we add all of those numbers up, we get $81,900. That property was placed in service during the second month of the year. So we're going to go $81,900 divided by 27.5 years, divided by 12 months in a year, multiplied by 10.5, because of course we apply the mid-month convention to that first month. So he gets half of February and all of the remaining 10 months in the year. And that gives him $2,606 of depreciation. The dishwasher is 5-year property that qualifies for the half-year convention. He essentially gets 20% of the cost of that asset in the first year, or $90. And then on the furnace and air conditioner, those are 27.5-year property. Again, we will apply the mid-month convention. It was placed in service in June, so we get half of the month of June and all of the remaining 6 months of the year. That's $4,500 divided by 27.5 years, divided by 12 months in a year, multiplied by 6.5 months of depreciation for the first year. That gives us a depreciation deduction of $89. So let's take a look at Rudolph's 4562. On the 4562, we make entries on line 19, and on line 19B, we enter the cost of the dishwasher, $450, and the amount of depreciation being claimed. On line 19H, for residential rental property, we enter the house basis and the depreciation on the house, and then we also enter that HVAC improvement that was placed in service in the month of June and the amount of depreciation being claimed on it. We total that amount up at the bottom of line 22, $2,785 of depreciation. Moving on to part 5 on page 2 of the form, we describe the car and the fact that we are claiming standard mileage on the car. We enter the amount of mileage being claimed on the car. For the car, we enter a description of the car. We enter the total business miles driven during the year, all other miles driven for the year, and answer a few questions. We didn't really give you enough information to know what we wanted you to say here, more that in the case of a real client, you would interview them, and of course you'd fill in those and not leave them blank. And here is Rudolph's Schedule E. We begin up at the top of the form by entering his name and his Social Security number. We then on line A answer the question, was a 1099 required to be issued? And the answer is no. If you look at the amount of expense he paid out during the year, mortgage is $8,500, fire insurance $200, miscellaneous repairs $350, and real estate taxes $2,000. The only amounts there that exceed $600 are the mortgage interest and real estate taxes, and those would be payable to entities that do not need to be 1099. So it's safe to say that no, he's not required to issue any 1099s. The next line, on line 1, we enter the address of the property, which we said was at the North Pole. It asks for the type of property from the list below, and if you go down to the list, then we have single-family residence. That's the kind of home that Rudolph is renting, so we enter code 1 to indicate that it is a single-family residence. Next on line 2, it asks us to enter the fair rental days. Well, Rudolph rented the property for the entire year except the month of January. There are 365 days in a year. He did not rent it for 31 days in January. 365 minus 31 is 334. That is the number of fair rental days. Under the days of personal use, we've left that blank. Again, the property has not been used for personal purposes after it was converted to rental, and therefore personal use days is 0. Moving on to the income line, we have $1,200 times 11 months. That's $13,200. So $13,200 of rent income. Then we enter the other expenses for the year. One of the expenses we have is mileage. We have 250 business miles, and for the first half of 2011, the standard mileage rate was 51 cents per mile. 51 cents times 250 miles is $128 rounded, and that is the amount that we entered on line 6. Then on line 9, we enter insurance. And of course, although insurance was for a full year at $200, Rudolph only rented the house for 11 months. So he's going to be allowed 11/12 of $200, and that is $183. He will also be allowed 11/12 of the mortgage interest and 11/12 of the real estate tax. 11/12 of 8,500 is 77.92. And 11/12 of 2,000 is 1,833. Now, all of the miscellaneous repairs were claimed for a period after he began renting the property, so all $350 of repairs are entered. And then finally, the depreciation deduction from the depreciation schedule and Form 4562 is $2,785. We add up all of the expenses on lines 5 through 19, and we get $13,071. $1,371 from $13,200 leaves Rudolph with a profit of $129,000. Now it's time to move on to Schedule E, page 2. And on Schedule E, page 2, we need to enter the income flowing through to Rudolph from his K-1s. And the first K-1 that we're interested in is the K-1 being issued by the LLC, filing Form 1065, Reindeer LLC. It shows a $10,000 loss. But we've already discussed the fact that Rudolph is passive in that activity. He will not be allowed to claim a loss on the activity that exceeds his income from other passive activities. He has $129 of passive income from his interest in the rental property. So that means he will be allowed to claim a $129 passive loss on Reindeer LLC. And the remaining loss of $9,871 is going to carry forward to 2012 and future years. On Toymakers LLC, we have a $5,000 loss, but again, Rudolph cannot claim a loss that is larger than his basis, and his basis was 0 at the beginning of the year. He invested $2,000 during the year, so $2,000 is the most he is allowed to claim as a loss. We've entered the $2,000 loss under the non-passive column. Now, on the Schedule E, page 2, he will enter the loss from Toymakers, Inc., under the non-passive column, because we told you that with Toymakers, Inc., he is an active participant in the operation of that S Corporation, compared to Reindeer LLC, where he is passive. So for Reindeer LLC, he will enter the allowable loss in column F as a passive loss allowed. And for Toymakers, Inc., he will enter $2,000 in column H, where it shows non-passive loss allowed of $2,000. We add up those loss amounts, and they total $2,129. Then on line 41, we are asked to total up our income from Schedule E. And so we take $2,129 of allowed loss on line 32, and we add to that the profit from line 26. So essentially, line 26 reduces the total from line 32 by $129, and that means the amount on line 41 is $2,000, and $2,000 is the loss that will carry over to line 17 of the Form 1040. So let's go take a look at Rudolph's 1040 now. Of course, he is a single filer. We're entering on line 7 his wage income of $50,000. On line 17, he is allowed a loss of $2,000. His adjusted gross income is $48,000. He is claiming a standard deduction and a personal exemption. His taxable income is $38,500. His tax is $57.56. He had $5,000 withheld on his W-2, so he owes $756. We also need to attach Form 6198 to show the at-risk limitations that Rudolph is subjected to. His current year profit or loss from the activity Toymakers, Inc. is $5,000. He is allowed to claim only $2,000 because that's his basis, and how to complete the form is just shown here. The next form in line is Form 8582. This form is used when passive activity loss limits are in effect, and the amount of loss that he had for the year is $10,000, and the amount of passive income he had for the year is $129. So we enter the passive loss on line 3B, his passive income on line 1A, and on line 4 we have the disallowed loss for the year of $98.71. That will carry forward to 2012. And we have an overflow statement included in the answer key for you. This just shows how we've added up certain totals to arrive at numbers that have been entered on various lines of his tax return. Also included in the answer key is a complete copy of his depreciation schedule. It's essentially the same as what was included in the problem. So that concludes the review of the classwork assignment for session 19. Let's now take a look at the homework assignment. And the homework assignment for session 19 involves preparation of a tax return for Mickey and Minnie Mouse. They too have a rental property and they too have Schedule K1s. We have a Schedule E that you will need to prepare, a Schedule E page 2, a 4562, and a passive activity loss limitation form 8582. Mickey and Minnie Mouse live at 125 Main Street in Magic, California, and they need some extra cash. Bad economic times for Mickey and Minnie, so they decided to rent out one of the bedrooms in their home. And who did they rent to? Well, on March 1st, 2011, they converted one bedroom to business use. Their tenant, Goofy, has the exclusive use of that bedroom as well as one bathroom. Goofy shares the kitchen and living room with the Mouses, and Mickey has calculated that his home is 30% tenant use and 70% personal use. The Mouses have the following income and expenses. Mortgage interest is $10,500. Property taxes are $3,000. Hazard insurance is $600. Advertising costs are $100. Utilities are $2,000. Cleaning and maintenance after March 1st is $500. Repairs to Goofy's room are $550. They had a new roof and a new range installed into the home. And the Mouses purchased their home back in 2000 for $90,000. At that time, the land value was $30,000. The fair market value of their home currently is $170,000 with a land value of $50,000. Goofy paid a refundable security deposit of $800. He also paid first and last month's rent of $500, and then he paid $500 a month for the months of April through December. The Mouses made cash donations of $1,000 to the Nature Conservancy and $500 to Food Aid. Mickey is a passive at-risk partner in Pluto Inc. Her Schedule K1 is attached. Mickey works for the City of Magic and his W-2 is attached. Prepare his tax return. And here is the Schedule K1 for the S corporation called Pluto Inc. And your job is, of course, at this point to complete the homework assignment for session 19, which involves preparation of a tax return for Mickey and Minnie Mouse. And I will see you next time at the beginning of session 20. Thank you and bye-bye.